Good morning. This is Yahoo Finance Live. I'm Julie Hyman with Jared Blickery and Brooke DePalma. And we are awaiting consumer price index data that is coming out right now here. Let me bring you the numbers. 0.4% is the CPI month over month. That is bang in line with estimates. Ex-food and energy, though, a little bit hotter than estimated, rising 0.5% versus the 0.4% that is estimated. Let me tell you about the year-over-year numbers as well. 6% year-over-year headline, 5.5% core, that is excluding food and energy. So both of those right in line with estimates. So we actually saw a touch of acceleration in the CPI number on a month-over-month basis. This is not what the Federal Reserve wants to see, so let's call it a little bit hot here, of course, following on the heat that we got from these numbers in January. All of these numbers I've been discussing right now are February numbers here. When we talk about these numbers, obviously there are implications on a number of bases. It means that people are paying more for stuff, right? Paying more than they did the month before at a time when inflation has already been taking a big pinch and a big bite out of people's wallets and pocketbooks and family budgets. The other big implication, of course, is for the Federal Reserve and whether they're going to be raising interest rates. And Jared,
yes,
that question is a lot murkier now than it was last week at this time because of the implosion of Silicon Valley Bank. And so now the Fed has to consider that and the soundness of the financial system in addition to its dual mandate of price stability and full employment.
Yes, and I can't underscore the importance of this report enough, because had this come in weak, had this come in more favorable, showing less inflation, this would have given the Fed a free pass to skip over the next meeting, saying we're not going to hike rates at all, or we're going to raise rates by 25 basis points. Here, they almost have to raise by 25 basis points. I've seen speculation that they may dabble with some reining in of quantitative tightening, because remember, they're going through a process where they're winding down their balance sheet. That's draining liquidity. That's creating issues in the bond sector for banks. Part of that is why SVB failed. And just taking a look at the Wi-Fi Interactive here, we got some initial reaction in stocks here. So this is S&P 500 futures. Hard to see, but this little candle here, this is a 1-minute candle, dipped all the way down to lows around 38.55. Then it's back up. So pretty much net, not really going far to the upside. Nasdaq futures showing a very similar story. Got this long tail here, tested the overnight lows, but back up. Dow futures, I'm going to think, yeah, pretty similar situation. And let me show you what's happened over the last 5 days here. Here's the Dow. Let me just go to the S&P 500 futures. And you can see really volatile price action coming into the late last week, but things have settled down a little bit after, I guess, markets have had a little bit of a chance to digest this failure. All in all, we were talking about the Federal Reserve. I think this creates a situation that the next meeting next week is going to be a referendum on financial stability in the U.S. Because if the Fed has shifted into the macro-prudential mode where they're more worried about systemic risk than they are about the immediate effects of price inflation, that would be a big change.
Yes, it would. It would be a very big change. And we should mention, as I mentioned, there's sort of two aspects of the CPI report. There's what the Fed aspect, and there's like what people are actually paying. So the Fed doesn't really consider food and energy, but we all do. And that's why Brooke is here. She's taking a look at the food equation. So Brooke, What are you seeing in those numbers?
Well, I first want to start with some good news here. Eggs, hot topic for many consumers out there. Month over month, they're actually seeing a decrease of 6.7%. That is the largest decrease that we've seen in quite some time. Of course, last month, eggs were up 70% year over year, up 8.5% month over month. So this year over year, eggs still up 55.4%. Taking a larger, broader picture, food up 0.4%, but groceries up just 0.3% month over month. Year over year, though, still seeing some inflation there, up 10.2%. Now, if we take a look at food away from home, that's actually bumping up a bit month over month, up 0.6%. Year over year, food away from home, so dining at restaurants, bars, up 8.4%. Now, once again, eggs seeing a decrease there. Meat, poultry, fish, and eggs brought down lower, down 0.1%. By that egg number, that's one of the biggest food spending categories. And so maybe some relief here coming for consumers.
maybe a little bit of relief coming to consumers. But if the Fed is still raising, then that's, has other repercussions, of course, across financial markets on the flip side. Well, that does it for our capsule coverage here of CPI. We're going to be back at 9 a.m., of course, with much more about the implications for the Fed on CPI, and we will be digging in deeper. Keep it right here on Yahoo Finance.
All right, let's stay, of course, on this. The venture capitalist community continues to reel in the wake of SVB's collapse. So what's next for these upstarts? We're joined by a pioneer in the VC space, Primetime Partners chairperson and co-founder, as well as Greycroft co-founder and chairman emeritus, Alan Patricof. Alan, great to have you on here this morning. Just have to get your thoughts on the past couple days we have seen in the venture capitalist community.
Well, it's certainly been a roller coaster. Provided, I would euphemistically, jokingly say, entertainment for a not very relaxing weekend. I mean, this in a way has been a long, long time coming. I mean, it's been brought on by exogenous factors that have nothing to do with the basic fundamental of venture lending, which is really what SVB and Signature and many other banks around the country, particularly in the West Coast, have been doing, which is lending to venture-backed early-stage startups, which are, by their nature, startups in high risk, with many of them without significant revenues, and providing lines against those to those companies, which were, in my opinion, totally justified or totally explained, that's a better word, by their assumption that the venture capitalists who backed the equity of these companies, to whom the banks were extending lines, would come in and supply equity capital almost before the bank lines would be drawn down or simultaneously with, and that in the meantime, they were getting huge deposits from the financings these venture capital backed companies had done. And it was really a kind of lending that in 40, 50 years ago, before SVB, would have been called senior preferred type financing. And SVB came in and invented a whole new concept of what they call venture lending, which was to make loans out of things that would have normally been senior equity. So but that in the end isn't what, in a way, what tipped them. I gather it was because they went long on their maturities and they couldn't deal with their short-term demands of these lines being drawn down, and it created a very dramatic, quick mismatch. And of course, they have the deposits of every one of these companies, and as it has been stated, and is absolutely true, there are thousands of companies who have deposits with these banks, which are perfectly legitimate deposits, and the banks' the deposit assets were perfectly fine, but all of a sudden they're put in jeopardy because of the bank's own problems.
Right. And Alan, just to be clear here, you guys are based in New York, I believe, but obviously you're in the startup business as well. Did you or any of your portfolio companies have money at SVB, and what now sort of happens to the wider community as a result of this bank going out of business?
Well, you were asking me a question, which I've been in the venture business 52 years, and to say I don't have any investments that are affected by this would be ridiculous. Right. We have, going back, 40 years ago to when the SVB started, many of our companies took advantage of lines and from these banks and gleefully called down on those loans. And many, we have a portfolio, fortunately, is not in prime time, is I'd say almost all our companies have not drawn down on their line. So they're sitting there with deposits in these banks, but for those who used any of these banks, and that was limited, and limited size of deposits and limited size of exposure. They are now in a position like every other venture-backed company that is expected to draw down on lines as part of their financing plan, are now going to have to, and that's the key thing here now. I mean, they're going to have to look for alternative sources of capital, because my assumption is that this type of lending is going to change dramatically, and that banks are going to be very, very cautious about lending to early-stage startup companies under the assumption that they're traditional, in quotes, loans, if you will. And I think that it's going to open up the need for convertible debt financing from other types of lenders or investors, I should say, or the preferred stocks. But it's going to take more of an equity characteristic to it, and not require loan servicing and repayment, which traditionally venture loans that were made by SVB, Signature, and all the others, by their character, required at some point. So I think that's going to open up opportunities for new types of investors, and at the same time, I am sure that the terms are going to become much more severe and more appropriate to the risks that are being taken. They'll have a senior characteristic to it, but it'll be a senior equity rather than disguised as venture debt, unless there are firms that have venture debt that have assets and have revenues and maybe profits, and where the SVBs and Signatures were going to make a lot of their money was not just from the loans and the interest rates, but from the enormous amount of warrants that they got in each of these companies. So when they made extended a line, they were getting warrants, and they were also getting deposits. So, as long as the system kept working, it made sense, and that's why the banks were prospering in the market. Now it's all come home to roost, and for reasons that had really nothing to do with the fundamentals of the businesses. They didn't overnight change what they were doing. It was really the bank's problems.
Alan, how concerned are you that what the Federal Reserve is doing in terms of raising interest rates, and going back to see how far they have raised interest rates already this cycle, how concerned are you that their efforts will make this situation worse?
listen, I don't have any insight, nor does anyone else on this show. I would guess that they would not raise. Listen, at this particular moment in time, I'd let things rest for a while. I let the banking system find a level that is comfortable. Excuse me. That the market's opening. It just evidently opened 2 minutes ago. I'm not watching the tape in any way. We're going to see, how the system adjusts to itself. I think a lot of people, I'm certain a lot of companies are now going to test the ability to, get their deposits to the extent that they need them, just to make sure that they really can access them. And secondly, people are going to test to see the lines they have really are there, maybe even if they don't need it. So there's going to be put pressure, and I think the Federal Reserve has said they're going to make liquidity available so that a lot of companies, let's say a young company is at a very early stage, losing several $100,000 a month, has a few $1 million in cash in the bank. My guess is they'll access their line, wherever the bank line is, and draw down some $500,000, $1 million. I would doubt whether they go draw their whole line down and see if really the wire transfer comes through. And, I think over the next several days, that will probably give confidence that these lines are going to be met where they have been extended. I mean, the Federal Reserve is not going to assume the lines that are outstanding for SVB or Signature or anyone else. I mean, they're going to protect the deposits, which is the right place. Mm-hmm. But if you had a line at any bank today, you're going to have to secure today to find out whether the line is really still good. Yep. And alternatively, if you don't, to seek some alternative type of financing, which may not be, I would doubt whether it will necessarily be what we've called venture debt in the past.
Yep. All right, we'll leave it there for right now. Primetime Partners chairperson and co-founder, as well as Graycroft co-founder and chairman emeritus Alan Patricof. You're always gracious with your time for us. We appreciate it. Thank you.
Pfizer has agreed to pay $43 billion, including debt, for biotech company Seagen and its pioneering cancer treatments. With more on what this major merger means for his company, we're joined by Pfizer CEO Albert Bourla. Albert, it is a pleasure to talk to you here today. Congratulations on this deal, which, as I said, is a big one. And in reading some of the analyst coverage, they are talking about the fairly hefty premium that you're paying for Seagen. Presumably, you had to outbid some peers. There had been some reports of others being interested in the company. Why is it worth it for you guys to buy this company and at that price?
Let me start by what we are trying to achieve, right? Is to battle cancer. And cancer, it is one of the deadliest diseases in the world. Right now, 1 in 3 people are said to get cancer in the course of their lifetime. And ADCs, which is the technology that Seagen is mastering, is considered one of the best ways to be able to battle cancer. So in reality, what we try to do, it is to be able to make a meaningful difference in the health of people, as we did with COVID, but now in another extremely dangerous disease, which is cancer. And we looked into multiple opportunities that would allow us to do such. And Seagen stands out for the tremendous complementarity together with our own capabilities. By putting 1 + 1, we do not expect to have 2, we're expecting to have 3 or 4. And that's very good news for cancer patients.
And as you say, this ADC, antibody drug conjugates, which is supposed to be a more targeted way of attacking the cancer, this is sort of a bet on that technology. You know, you and I have talked throughout the pandemic and now as we enter a new phase, and you really made a name for yourself at Pfizer in terms of vaccines, getting the speed to market, the way that you attacked that issue. I wonder when we're at the tipping point for cancer in that regard, because obviously this is something that folks have been working on for a long time. Do you feel like we're getting closer to more meaningful ways to fight it?
I think we are, and since today we are even closer, because exactly what was missing was the match between a company with our own capabilities, our ability to develop clinical development at scale, at the speed that you just spoke, the ability to manufacture at quality and high speed, our ability to put financial and scientific resources in the hands of a group of people that have done some miracles with the technology that they used in cancer, which is the Seagen people, I think will deliver results equal to the results that we were able to see in COVID.
When you talk about the sales you guys expect from Seagen, $10 billion is the target by 2030. Last year, you had about 12% or so of your sales contributed from cancer treatments. You know, you've got the COVID medications and treatments and vaccine that are declining in sales now. You've got some other things that are rolling off that you have patent protection on. How much of a percentage, how important is cancer going to be as a franchise to Pfizer going forward?
Look, cancer before COVID was way higher as a percentage, so it was a very big part of the non-COVID business. But still, it was not among. We were not among the biggest oncology companies, right? I think the combination with Seagen will make us way more competitive in the space. And it's not the size of Seagen as it is coming right now, which is already $2+ billion of current sales, but it is, as you said, the growth potential that they have, because those sales are coming from 4 products that have just been introduced, and there is 15 new pipeline products that are coming. So we'll exceed $10 billion. With $10 billion in year 2030, we'll be a significant player.
Albert, the administration has been relatively aggressive, the Department of Justice, the FTC, in scrutinizing deals. What's your level of confidence that you're going to get approval for this one?
It is very high. I don't think you can find a cleaner deal. There's no overlap. Okay,
that's a short and sweet answer. You know, given the events of today, I want to turn to Silicon Valley Bank and kind of the fallout, the broader fallout. We've heard some folks talk about what this is going to mean for biotech startups, for valuations there, et cetera. I know you're just announcing a big deal today, but I do wonder if you're casting your eyes to some of these biotech startups and you see some opportunities as a result of the fallout.
Right now, what is my concern when it comes to Silicon Valley Bank? It is what could be the impact on these startups, because we are all part of a broader ecosystem. It's not how we can get our hands around them and steal the companies now that they are in dear need. Not at all. It's not how we operate. And I don't think many of these companies that will face financial distress are really acquisition targets right now. They need to progress their job. But I'm wondering how to make sure that we ensure that they won't disappear. A lot of startups that can become eventually companies like Citizen one day. It's very, very important for our ecosystem. And I'm monitoring the situation and the announcements to see where this goes.
So what would be the way to support them potentially on the part of the industry? Would it be, starting some sort of fund to invest in some of these companies, for example?
That could be one of the options, but I think right now we are looking to see if the government will do something, which is quite, I think, important. But beyond that, if nothing else happens, we should see what could be our options to be able to help them.
There's one other question.
It's going to be very bad for science, if a bunch of startups for no reason just disappear. Startups that could provide the Alzheimer's medicine, the cancer medicine of the future.
Certainly, that makes sense. There's one more quick question I have about the fallout, though, which has to do with the credit markets, because you are planning to finance this deal, at least in part, by selling debt. Any concerns about that kind of a sale in this environment, given what we're seeing unfold?
No, we calculated that will not be very cheap. Like it is now higher interest rate. So we know that will be a blended interest rates around 5%. And, it's not pleasant to have to pay these interest rates, but it is way within our ability to raise debt.
Albert, good to see you. Thanks so much for joining me today. I really appreciate it. Albert Bourla is the CEO of Pfizer, talking about the acquisition of Seagen. Appreciate it.
Thank you very much.
I'm Julie Hyman with Jared Blickery in for Brad Smith. This is Yahoo Finance Live. Let's get right to the 3 things you need to know to start off your morning. First thing you need to know, headline inflation comes in as expected at 0.4% month over month in February. We're talking about the CPI, consumer price inflation, but the core number, that's the Fed's preferred gauge, landing at 0.5% on the month, slightly hotter than the forecast 0.4%. All of this complicates the Fed's tightening plan as it battles the contagion caused by the collapse of SVB. Expectations for rate policy are varying widely as a result of the turmoil. Just days ago, a hike of at least 25 basis points was baked in. Now some analysts see the central bank standing pat next week, and one, Nomura, actually sees a cut as a possibility. Second thing you need to know, the fallout from Silicon Valley Bank's collapse continues. Bank stocks are looking to claw back some of their losses this morning, even after Moody's Investor Service put 6 banks on watch for potential downgrades, citing, quote, extremely volatile funding conditions. And regulators are reportedly planning another auction for SVB after they failed to find a buyer over the weekend. Meanwhile, the Federal Reserve has opened an investigation into what led to the failure of the bank, as critics point fingers at legislative changes to federal oversight, with others blaming the central bank itself. And third thing you need to know, SVB's deep ties with tech have put companies like Roku and Etsy in a vulnerable position. Shares of the 2 companies have taken a hit after they reported exposure to Silicon Valley Bank. Even when they retrieved their deposits as expected and as the Treasury has promised, questions remain about their decision to rely so heavily on one financial institution. Roku is one of the most exposed firms to the collapse, with $487 million tied up with SVB. Well, given all of this, given the CPI, given the continuing repercussions and reverberations of SVB, Jared Blickery is manning the Wi-Fi Interactive with a look at what we are watching this morning. Jared. Guess
what? You'd think inflation just went away. S&P 500 futures up 1%, actually almost up 1.25% here. Let me just show you the intraday overnight price action. Hard to see here, but we actually spiked down and tested these lower levels in the initial seconds after the report. But despite core services coming in hotter than anticipated, we're still seeing a rally here. And that also extends to what we're seeing in the bond market. Let me just find the 10-year. Here's the 10-year, which had a huge day yesterday. And let me just show you a 2-month candlestick chart so we can really get a feel for what's happening. By the way, only last week we were at 4%, then touched 3.5% yesterday, and we have bounced right back up about 6 basis points. So historically, that's a large amount, but not within the context of recent price action. Here's the 13-week T-bill yield, the very front end of the curve, tracking what the Fed is doing. That's up in another 11 basis points. So if the Fed still has to stay hawkish, you got to wonder what that's going to do for stocks here. But in the meantime, financials really bouncing back after the rout that we had yesterday. XLF, that's up 3.7% in the pre-market. That's after being down 4% yesterday. XLY, consumer discretionary, tech, communication services, all those seeing some love this morning. Just a quick look at the Nasdaq here, going to show some of the big movers. Apple up more than 1%, so is Amazon. Microsoft almost there with them. Tesla up more than 2%. And got to get a check of crypto here, because guess what? Bitcoin, I've said this many times, Bitcoin has been a leading indicator off a lot of these inflation reports. Here's a 2-day view, and it is right up by the highs that we saw overnight. So even Bitcoin liking the risk rally here. What can I say, Julie?
I don't know. What can we say about that? We're going to say a little bit more about it later on in the show. Thanks, Jared. Moving back here to focusing on CPI. As we mentioned, the core number coming in hotter than estimated, rising by 0.5%, even as headline inflation on the consumer level remained unchanged, 0.4%. Let's bring in PIMCO Managing Director and economist Tiffany Wilding now to discuss this. And Tiffany, as we've been discussing, the Fed always has a tough job, but perhaps even more so now, where we're seeing inflation is still relatively hot, still accelerating, and now we have the SVB mess. What do you expect all of that to equal when it comes to the Fed?
Yeah, so I really think that it's all about how much financial conditions have tightened as a result of some of these bank failures, I guess, over the weekend. And that's something that the Federal Reserve is going to have to try to understand. The way their monetary policy works, obviously, is through the banking channel and broader credit markets. And, the question is, will you see credit creation as a result of this news, really start to decline? And ultimately, that's what the Fed wants. They want this sort of easing in credit conditions or credit creation to cool off demand in the economy, cool off inflation. But nevertheless, they don't want that to happen too quickly. They don't want the economy to sort of plunge into a recession. So that's really going to be kind of the balancing act that they are going to, to try to have here. I think inflation, obviously it came in a little bit hotter than expected this morning. It's a lagging indicator. We have to keep in mind, and so we have real events that are happening in financial markets that will be leading indicators that they have to deal with. But again, it's kind of uncertain how much these two banks are tightening financial conditions at this point. I think as you guys mentioned, the equity market, hasn't really moved. Kind of the broad indices have been more muted relative to, some of the financial equity indices. But that's really going to be what they're focused on.
And Tiffany, Powell is in quite the interesting position here. On the one hand, as you correctly point out, he's dealing with a crisis, a banking crisis that has evolved in real time here, coupled with the inflation data, which came in hot on the services side, which he doesn't like, but admittedly on a delayed basis. I'm wondering, is Powell going to wear his macroprudential hat next Tuesday and Wednesday, or is he going to more be focused still on inflation? And is there a happy medium here that he can just kind of straddle a line?
Well, I think there is reason for them to actually pause interest rate hikes. I think it's very little cost for them just to do that. Still have, still communicate that they could start interest rate hikes, but just to see what happens. Let's see the fallout, from these two bank failures and the FDIC, the Treasury, the Fed announcements over the weekend to try to shore things up. I think it's relatively low cost for him to do that. And it could provide some information, could provide some time for them to try to assess what's going on. But again, overall, this is a balancing act, as I suggested. And the Fed, ultimately, in order to pause, like I said, they will have to deem that uncertainty around financial stability risks is higher, than some of the uncertainty around inflation risks. And again, I think because this is early days since the fallout, I think there is reason for them, to kind of tread a little bit lightly here, but nevertheless, you're right. Inflation is high, and they're going to have, if they do decide to pause, they're going to have to communicate very carefully, that, even though inflation is elevated, they are doing this for financial stability type of reasons.
Tiffany, even though I know the balance of attention has shifted to financial stability, I do want to dig into CPI a little bit here because it is interesting to see that continuing persistence, right, and stickiness of the acceleration in inflation on the core level. I know if you back out some of the components, I believe shelter is seeing a little bit of an improvement there. And if you look over the past 3 months, we are seeing some abatement. But do you think that, if the Fed does continue to raise, even in the face of everything else that's going on, is it going to continue to have a positive effect on these consumer prices?
I think the bottom line is that financial conditions, even before these bank failures, they were tight. And the Federal Reserve had put monetary policy at a place to restrict the economy. And that's why I say, the bank failures, they're not happening. They're symptomatic of these broader, the broader environment of tighter financial conditions. So ultimately, the Fed is hoping that brings down inflation. And I think, if you look at the components, of inflation more recently, kind of in what, some of the revisions that we've gotten, what you see is that inflation actually does, look relatively sticky at an elevated level, unfortunately. So there's a reason why the Federal Reserve has put monetary policy in tight, in restrictive territory. But I would have to say that, I think the policy is working. Inflation, with a lag, should start to come down. And obviously the Federal Reserve needs some more data in order to, to feel more comfortable about that. But again, I think to the extent that credit creation really starts to slow, you will start to see inflation coming down.
All right, Tiffany. So let's imagine in 1 week's time or so, you're sitting, if you were in the press lockup room with Jay Powell as he takes the lectern there. What question would you ask him? I've got $1 million.
Yeah, well, I mean, obviously, you're going to know what he decided to do at that point, right? So the meeting will be revealing in that sense. If they don't hike, they do think that there is some lingering financial stability risks that outweigh, some of the inflation risks. But I think overall, like the big question will be, how are you thinking about policy moving forward? So even though you're pausing today, do you expect to continue hiking rates maybe at future meetings? Do you think policy is restrictive enough to ultimately bring down inflation? Those are the kinds of questions, I think people will be, they should rightly be focused on.
All right, we got to leave it there, but really appreciate your insights, especially on this economic report late morning here. PIMCO Managing Director and Economist Tiffany Wilding, thank you for joining us. Excuse me. The fallout from Silicon Valley Bank continues to rattle the markets as investors assess the possibility of wider contagion in the financial system. And guess what? Julie, we're talking about SVB here, as we have been, and the news overnight. So we're getting some credit downgrades on a lot of the competitor banks here, and we're seeing a lot of these banks snap back. I'm looking at the Wi-Fi Interactive here, some quotes on the screen here. Some of the worst performing banks over the last few days are seeing the biggest increase here. So FRC is up 56% in the pre-market, as you can see there. It's in the upper left. Maybe you can't see it. I'm trying to make it a little bit bigger. Well, anyway, that's up 56%, PACW up 50%, and the list goes on. So I think a lot of investors saying, all right, the funding crisis is over. The Federal Reserve has stepped in. They've given depositors pretty much a pass, more than a lot of people expected to happen. And this short-lived crisis is over. On to the next battle. But where is that next battle?
Yeah, I mean, that's really what remains to be seen, which we're going to talk more about in a moment. 6 banks overall were placed on watch for downgrade. You mentioned FRC, also Western Alliance, Intrust Financial, UMB Financial, Zions Bancorp, and Comerica were the ones that were put on review by Moody's, and many of those are the ones that are bouncing back. PacWest, by the way, I believe not on that list, but that's one of the stocks that's also been volatile in the wake of all of this. So that's one of the things that we're watching here. We're going to get regulators are going to try again to do an auction of the SFB assets, which they did not succeed in doing over the weekend. We're going to watch that to see who ends up with this stuff, who ends up with the assets. And then the Federal Reserve, in addition for preparing for its meeting next week that we've been discussing, is now turning its lens inward and trying to figure out what went wrong here in this case. As we talked about with Bethany McLean yesterday, she pointed the finger in part at some legislative changes to Dodd-Frank that reduced oversight of this size of banks, right? Besides the 12 so-called systemically important financial institutions, all of the banks below that threshold are not getting as much oversight. And she said that's something that's to blame. Some have pointed the finger at the Federal Reserve itself, California bank regulators. It seems like there's a long list potentially of where, things kind of broke apart or didn't do what they were supposed to be doing. Yeah,
but I think it's just a function of we're always fighting the last battle here. We're always fighting the last 100%. Crisis, and so who was expecting interest rate volatility to rear its head after 40 years? Well, you could look at the charts and say it had to happen sometime, but it wasn't fait accompli that it was imminent. So there's a lot that's structurally different right now, and we're seeing some of the fallout from it. And we got to find out how to put the puzzle pieces back into place here as inflation rears its ugly head, continues to, and it's not an easy battle.
No, it is not an easy battle. By the way, one of the culprits that I did not mention was management of the actual bank.
Yes, that was terrible itself. The treasurer should be, everybody's been fired, I believe.
Yes.
But the treasury management was just absolutely horrendous, not hedging all that interest rate risk.
Yeah, so that's something to keep in mind as well. We're going to keep talking about this, of course, all day long, coverage of the SVB collapse. At 11 a.m., we're going to get perspective from a major lawmaker, that's chair of the House Financial Services Committee, Maxine Waters, of course, always outspoken on these issues. I'm really curious to hear what she has to say about all of this. Amid the collapse of Silicon Valley Bank, its clients were in the spotlight. Streaming company Roku is one of them, saying roughly 26% of its $1.9 billion in cash was held at SVB, but insisted it would have enough cash for the next 12 months, despite the deposits being largely uninsured. Companies like Etsy, Roblox, and Circle were also affected by the fallout. We are going to examine the aftermath with an analyst from Evercore ISI. Remember, these companies are supposed to get their money back, but there still be maybe questions about due diligence, et cetera, in the wake of all of this.
The common phrase surrounding the financial crisis of 2008 was, what will be the next shoe to drop? Well, as Wall Street eyes risk outside the banking system after the collapse of SVB, one strategist is drawing attention to all implicit or explicit carry trades. You can read all about this in today's morning brief written by our very own Julie Hyman over at the Yahoo Finance homepage. And let's take a deeper dive into what exactly a carry trade is. So, Julie, we've had super low rates around the world, roughly speaking, until recently for about 15 years. And if you borrow low at some of the countries that have the lowest interest rates, like Japan, well, you can use that money and buy assets in countries where assets are higher yielding, especially the commodity countries where things just carry a bigger premium. So just break down the piece as you were writing it.
So the carry trade, as you're referring to, typically refers to FX and rate markets, right? It's not something typically that most people think about. It's sort of a more sophisticated institutional way of trading. Marko Kolanovic, who is a very closely followed strategist at JP Morgan, exactly, he wrote about the carry trade and he talked about implicit and explicit carry trades, and he really broadened the definition, kind of in my view, of what he considers to be a carry trade. And I wrote about this in part in the morning brief. He talks about a lot of other things where people were borrowing low and then trying to get a higher return. Things like commercial real estate, things like auto loans, things like credit cards. He talks about private equity, which is also something that Tony Dwyer of Canaccord Genuity pinpointed. Venture capital, for example. So basically, in an era of easy money, there was a lot of borrowing in one place to try to get that better return in another. Now, SVB is just one example of where that kind of a trade is perhaps unraveling. And the question that I posed in the brief is, what's the next shoe to drop? A question that, in covering the great financial crisis, was asked on a nearly daily basis. Now, this is not the great financial crisis.
Very important.
But as Tony Dwyer pointed out in a note to investors, the next risk is the one that you're not looking for, right? It's the one that is perhaps hidden to the naked eye. And so it's almost inevitable that there will be other areas of vulnerabilities that are revealed.
Yes, and also because we're talking about the carry trade, and it's really a function of the Japanese bond market and all the bond buying that they've done for decades. If that blows up, that would also change the circumstances of the carry trade. So I would posit that that is on the table too, because Japan's debt has gotten to perhaps unmanageable levels in a rising interest rate environment. We don't know if that's happened yet. But if we go to the Wi-Fi Interactive, I want to show a chart of the euro versus the Japanese yen. Now, this is kind of one of those exotic foreign exchange crosses that is really seen as a barometer of risk. So when it's going higher, and by the way, this goes back 10 years. So when the chart is going higher, prices are trending higher, that means the euro is in favor. That's more risk on versus the yen. And so that is reflecting a carry trade, that people are borrowing or selling the yen, taking those funds and buying things, perhaps in euros, but also other places around the world. Now, when that reverses, and it oftentimes reverses suddenly at the end of cycles, as we're getting this credit crunch, as the Federal Reserve is just beginning to show that it's affecting the markets, that usually ends up with a rush into the yen at the very end. That is the end stage, and that's what I'm looking for as a barometer. Let me show you one more thing here, what's happened over the last 5 days. Now, we saw this sharp move lower on Monday. That was yesterday. That was coincident with the failure that we saw with SVB, that whole resolution. So this lower means money is flowing back into the yen. If this continues in a big way, that's a big marker for me that we're in that final credit crunch. But not there yet.
No,
we still have more to go, Julie.
How long can it last? Let's talk about that with Matt Miskin. He's co-chief investment strategist at John Hancock Investment Management. Great to see you, Matt. So first, I would ask you, where are you now looking for another shoe to drop, for the other vulnerabilities in the system in the wake of SVB and Signature?
Yeah, the ecosystem around the cryptocurrency space continues to be our highest risk kind of part of the markets. It's amazing cryptocurrency. Bitcoin has been rallying almost every day here, which is probably masking some of the underlying risks that still are embedded there. And then the commercial real estate market. You're just seeing the occupancy rates are still very depressed post the pandemic. Interest rates are much higher, borrowing costs are higher, and the liquidity is just low. So overall, I think you want to manage your liquidity risk as a paramount right now. So you want to think about those illiquid assets, those ones that have kind of potential gating, potential blocks on getting your money back. You want to manage those, and you want to tilt more into higher liquid assets. So those assets that trade frequently, those that you can get in and out of quickly, that's where you want to tilt into as an investor.
So if I'm listening to you correctly here, that means that a lot of the private equity investments that have those longer duration time frames, that have those gates, we still haven't seen the potential fallout there yet. Maybe they haven't had to report yet. I'm just wondering, where do you see the dynamics here? Could we have another shoe to drop in these alternative investment vehicles?
Yeah, so I mean, in terms of those vehicles, if you have a lot of redemptions in a very short order and they're trying to mark these things to market and they really have to, create some sort of pricing to them, but they can't find a price, then they got to be a price taker, meaning whatever the price is set and whatever they can get, that's what they're gonna be able to get out. I think in broader space, we're seeing still a lot of cash there. So there is dry powder. I think, private equity has opportunities if there are newer investments that, are seeing illiquidity in a fire sale or, depressed prices, they could actually take advantage of that. You just got to know what you own. So if it's an older vintage, meaning something that's been around for a while, they've already put that money to work, and you're looking for that liquidity, you're gonna probably have to wait. Newer vintages that are, still have a lot of cash, dry powder, they actually might be able to take advantage of opportunities the next year or so. But overall, more liquid assets versus lower risk assets, higher quality versus lower quality. That's kind of how we would position portfolios.
This is all, I think, useful to individuals for investing. I'm also curious, though, how we should be thinking about it holistically. In other words, is there anything here at the margins? Are there any more failures that are going to cause these ripple effects through the system, eventually affecting central bank policy, for example, or just the stability?
Yeah, Julian, what you're seeing right now is fiscal policy is really helping the global economy right now. So it's not just the U.S. So this, bailout, we'll kind of do some air quotes on it, because you can call it whatever you want, but that was a pretty significant move in terms of basically just blanket statements saying all depositors are backed. These FDIC limits were there, and now they're just completely backed across the board. They went above and beyond. Since 2008, the fiscal side has been more is more. Meaning they don't, say, well, why don't we wait, or why don't we do a little bit less than, we could. It's been almost this modern monetary theory, kind of thread where, just spend more money. It's okay. And I think that worked in the last decade because inflation was so low and you were able to do more fiscally. But now with inflation, what it is, like this inflation report wasn't good. 0.5% month over month on core is not a good number. And the Fed likely has, they still have an inflation problem. So the fiscal side needs to start making a decision. Are they going to keep stoking inflation, making the Fed's job harder? Or are they going to start actually backing off and saying, look, we've got to worry about inflation still, get this under control, and then save that money for when we have a real problem, when unemployment rate rises, when we go into a recession. That's when we need to save that money for. So unfortunately, I think the events as of late is going to stoke inflation versus bring it down, increase risk in speculative parts of the market for the short term. But we actually think the Fed's job's not done, and they're going to have to stay hawkish until this inflation comes down.
But Matt, egg prices fell 6.7% month over month. Everything's fine. Everything's fine. No, I do want to ask you for a long time, and this is something you and I and Emily, your co-chief investment, we've talked about this a lot. The fact that you guys have been long fixed income for a while, right? Going back to early last year. Now that we have seen this unraveling of SVB bets, are there any implications? Are you thinking about things differently at all? Are you in a better position now? Talk me through that if you could.
Yeah. So over the last 6 months, we've been in, middle of last year to now, we've been advocating moving more into intermediate, higher quality bonds, getting 5% to 6% in income, and sitting and waiting patiently as the cycle keeps going. The cycle continues to decelerate in our view. The Fed is going to be continuing to raise rates. I know that sounds counterintuitive to like bonds and thinking the Fed's going to raise the short end, But this is all somewhat normal in an economic cycle. When the Fed raises rates aggressively, that leads to recessions. That leads to solvency risk, issues in the credit markets, issues in just the banking system. This is actually a relatively normal playbook for a cycle. You want to hold that high quality bond right through the end. And I know that yields rallied a lot in the short term, and now the valuations aren't as attractive as just last week. But at the end of the day, we look at this volatility, you're not going to be able to time it perfectly. Just hold on, keep that high quality bond position right through the end of the cycle. When the Fed starts cutting, the curve uninverts, you get a steeper curve. That's when the new cycle is probably going to start. And then we'll be looking at picking through risk assets, finding the best opportunities there.
All right, a little breathing, calming breathing in these markets. Matt Miskin, thank you so much. John Hancock, investment manager, co-chief investment strategist. Matt Miskin, great to see you as always.
Good to see you too.
Coming up, Uber and Lyft were victorious in the battle to classify drivers as contractors out in California. We're going to talk about that and have the opening bell on Wall Street next. We're waiting on the opening bell on Wall Street here following the CPI report that we got here this morning, Jared, that came in at core a little bit hotter than estimated. And so now, as we've talked about, the Fed kind of has to thread the needle. Interesting to see stocks up to the extent that they are, futures up to the extent that they are, because perhaps what we're seeing is judgment from market participants that this is not so hot that it would, force the Fed's hand to go, say, 50 basis points, for example.
Right. Or, as I've been positing, that the Fed is simply not in inflation-fighting mode anymore, that they have higher risks from the macroprudential front, that is regulating banks. And if there is a liquidity crisis, I would expect them to deal with that on the quantitative tightening front, perhaps. And we'll have to see if that comes. A lot of speculation there, but that's what I'm going to be focused on for this next Fed meeting already within a week. I can't wait for it to be here. You can tell.
Yes, I know. And, it was really interesting just hearing Matt Miskin, just talk about people focusing on liquidity in their portfolios. I mean, as always, it depends on your time horizon, right? People have been pounding the table on real assets over the past few years. And if you own real estate and you don't need the money for a few years, okay, that's one thing. But if you want to have access to your money, maybe you don't park it in stuff that you can't get to easily. And then we've got Strategas ringing the opening bell. Some friends of ours up on the podium there. Our opening bell coverage sponsored by Tasty Trade. And we were just looking at the futures. Let's call up the cash open now that we're looking at what's going on with the major averages and this upswing that we have been looking at here in stocks. Now, part of this, I would also theorize, is a bounce back effect, a rebound effect.
Yes.
CPI was not worse, perhaps. A lot of the regional banks are coming back, even after Moody's put them on watch for downgrade because, well, they've already fallen so much. So maybe they've already priced in some of that outlook. I mean, of course, Jared, I think safe to say people are still concerned about failures elsewhere right now. But for the moment,
yes,
a little pause in the selling.
Well, for the amount of bond volatility that we've had over the last few days, absolutely incredible. We haven't seen anything like that since the global financial crisis. And I don't want to draw too many parallels. It's not completely fair to do that because it's not apples to apples. But nevertheless, I went back and studied the tape back there, and I'll pull up some charts in the meantime of today's price action. I studied the charts, and it took a while for Lehman Brothers to get priced into the markets. There was a snapback over a couple weeks, and then the bottom fell out. So these things take a little time to digest. Now, here's the S&P 500 up over 1% today. Over the last 5 days, still down about 2%, kind of in this lower end of its range, as we're seeing here. What's standing out to me is the small caps, the Russell 2000. That is up 3% today, pretty big amount. Still down 4% over the last 5 days. That has been more volatile than the overall markets. And when we take a look inside, what a market departure from some of the earlier days of, I guess, the sell-off that we had, especially considering last week. Yesterday wasn't that bad. Financials up over 3%, definite bounce back there. Materials up 2%, communication services also up 2%, real estate, industrials, tech. And well, that's all of those outperforming on the top rows here. And let's just take a look inside at the Nasdaq, which had a pretty good day yesterday. Some sectors outside of there that the Nasdaq doesn't represent didn't have the best days, but Nasdaq did. Meta up 4%, Tesla up 3%, AMD up 3%. And I want to take a look at some of the leaders and also the canaries, some of the fringier parts of the market. KRE, that is the KBW ETF, regional bank ETF, that's up 10%. And so is Bitcoin. We're going to be talking about that later in the show. But I just want to show you the regional banks here. A lot of grain, big departure from the prior days. But let me just show you the 3-day look. Still marred in red here. So let's not get ahead of ourselves.
Just for 1 second, can we go back to the NASDAQ stocks? Because I just want to zero in on Meta for just a hot second here. There have been a lot of reports, of course, about Meta cutting more jobs, and the company coming out basically and confirming it this morning, saying 10,000 more workers are going to be laid off during its quote-unquote year of efficiency. Mark Zuckerberg making that announcement in a blog post. So just confirming basically some of the reporting and the speculation that's been out there.
Yeah, pretty big candle that we're looking at. Meta pushing up against this resistance. Just do a quick technical analysis to see historically. So we were able to punch above some prior price resistance here. The story is really going to play out over 2 years, though, and you can see how depressed prices are given that decline that really started in 2021.
Yeah, and our Dan Halley is all over the story, and we're going to be hearing from him later on the 11 a.m. hour. In the meantime, we got to move to some other movers, and outside of the regional banks here in the U.S., we're watching Credit Suisse as well. The company's battled scandal for more than a year now. Feels like a lot. Feels like more than a year for sure. The company now is coming out and making some new comments here. The company saying it found material weakness in its financial reporting over the past 2 years because of what it said were ineffective internal controls. The company says it's been actually getting some decent inflows, but nonetheless, the internal controls of the company were not effective. The management team at Credit Suisse entered in 2022, so it looks like this did not begin at least under their watch. But at the same time, the company says its financial statements fairly present in all material respects the group's consolidated financial condition.
Yeah, my only thing to add to that, when a company has to go to the length to disavow their own financial control procedures, financial reporting procedures and their controls, that's a big deal for them. And they're in the process of divesting, I believe, their American wealth unit. And so kind of a big restructuring there for a European bank. And you want to look at a sector that has done very poorly until very recently, and the yield curve kind of explaining what's happened recently. But SX70 over the last decade and a half has been the biggest time-sucked money loser that I've seen in a while.
Yeah, well, interesting to see those shares of Credit Suisse. Not much change. They did fall yesterday. And we are also watching airline stocks. That's because there's a conference going on and a lot of these airlines coming out with some updated outlooks. United Airlines in particular signaling some turbulence ahead. It expects to see a quarterly loss, mostly to do with its labor contract, if not entirely to do with its labor contract. Adjusted loss for its first quarter going to be 60 cents to $1 a share. The company is saying 69 cents is what analysts have been looking for. The company before talking about it's not that different, I guess, from its prior outlook here, but it does talk about that there's a heavy weight coming from this labor contract. It didn't change its full year earnings, so it seems like it's going to perhaps recover from all of this. And operating revenue in the first quarter will be up 51% year over year because of strong demand, but the stock is falling because of this concern over the pilot's contract.
Yes, and I do have some analyst commentary. This from Citi recommends a stock with a buy, saying expenses are now, quote, front-loaded, though the full year still looks solid. Despite a bumpier outlook for the first quarter, United reiterated all other aspects of its 2023 guide, and then they're recommending treating any big stock price dip as a long-term buying opportunity. So I don't know how big 6% is. I look at the price chart on the 5-year chart here on the Wi-Fi Interactive. This just kind of shows, I like to use 3 to 5 year time frames to see what happened over the pandemic. And this really never even began to reclaim, I guess it began to, but never really quite reclaimed even the prior floor for stock prices here. So that's pretty big there. And that's the case with a lot of these airlines.
Yeah, and just to check quickly on some of the other ones as well, Southwest, which of course had all of those scheduling issues in December, said it upgraded the software tool that it uses to schedule flight crews. That's something it had said it was working on to address all of these issues, right? So that was an update. It narrowed its first quarter operating revenue guidance. We heard from Alaska Air, which cut its first quarter margin forecast because of higher fuel costs. We heard from Spirit Air, which said its operating margins in the first quarter are going to be worse than estimated as well. So a lot of these airlines coming out with this kind of commentary today. And on balance, it doesn't seem like it's quite as good, in part because a lot of them are suffering from these higher fuel costs right now.
Yes, they are. And moving on here, shares of Uber and Lyft steering to the upside, and that's following a California court's ruling on allowing the rideshare companies to classify their gig workers as independent contractors instead of employees. Now, this removes some of the future regulatory risks, and just looking at the stock reaction here, I have it up on the Wi-Fi Interactive as well. You can see Uber up 7%, DoorDash also up 7%, Lyft up 8%, although a much smaller square there. And let's just check and see how this compares to the year to date. Still in the green for some of these. Look at this. Uber up 33%, Lyft down 16%. And I remember this dynamic playing out when we were covering their earnings, what was it, a few weeks to a month ago. Just very different execution styles for this environment, and that's what it takes.
Yeah, there's a note out from Jefferies reacting to this decision, calling it a big win for Uber and Lyft, DoorDash too, any of these like sort of gig economy companies. Basically, the estimates here is that Uber, Dash, and Lyft avoided $170 million for Uber, $100 million for Dash, and $20 million for Lyft in EBITDA headwinds. In other words, it would have cost these companies a lot more money had this gone through because of these workers being classified in a different way. And so that's something that is obviously positive for these companies. That said, according to this note, it'll likely be appealed to the California Supreme Court. So still this is not the definitive end of this situation, but this is a positive step for many of these companies that have been fighting this tooth and nail for quite some time.
Yes, I remember talking about this story in 2017, 2018?
Yeah, it's been lingering around for a while.
And as you said, it's going to be probably another year now before we get the definitive. All right, coming up, Roku was caught in the crossfire after the collapse of Silicon Valley Bank. We're going to speak with an analyst on what this means for the streaming company up next. And Collapse of Silicon Valley Bank, several companies were caught in the crossfire. Streaming company Roku said it held 26%. Welcome back. Amid the collapse of Silicon Valley Bank, several companies were caught in the crossfire. Streaming company Roku said it held 26% of its $1.9 billion in cash and was unsure what to extent it would be able to recover the funds. E-commerce platform IXIC also tangled in the downfall. Company has to begin processing seller payments throughout its other payment partners after warning of delays in the aftermath of SVB. Now joining us to discuss what happens next is Evercore ISI Managing Director Shweta Khajuria. Thank you for joining us here today. So big picture, I thought Roku might have gotten hammered for a bit more, but it looks like at least they have access to their deposits. Any word if they're able to access the funds? What's the situation on the ground there?
Well, first of all, thanks for having me. Second, it seems to us that initially when they filed their 8K, we thought that it would take months in terms of receiver certificates and expected dividends that they would get from the cash that they held at the bank. But now it seems that it could have been as early as yesterday, although we haven't heard that they received the full cash. We are speaking with them today, so we'll have more information intraday today as we speak with them. But what is for sure is that they will get the 26% of their cash that they had at Silicon Valley Bank. And the second thing also is that for the stock in itself, I mean, the stock didn't trade off that much, or in fact at all. The reason is because they do have enough cash for their day-to-day operations, at least for a year, if not longer, and they will have the remainder of the cash by that time.
So Shweta, how should investors be thinking about this? For Roku specifically, is this a non-issue? Or even if their cash position is fine, are there questions that need to be asked about making the decision to have a relatively big relationship with this one bank? How are you thinking about it?
Well, two things. One is that it is largely a non-issue as long as they get their cash back. And second is it certainly now is a question of how to diversify, not only for Roku, but there were a lot of other private companies too that had all of their cash held at the bank. And so now there's an increasing awareness to diversify the cash pool across banks, just like you would with line of credit. You'd have several lenders. The same way, now there's an increasing awareness for anyone who had a concentrated position of cash at a particular bank to diversify their positions. I would assume that Roku will diversify their cash position across different banks more than they did before.
And what about some of the other companies you're taking a look at here? Peloton had a little bit of exposure, maybe Etsy, looking like Trade Desk didn't really have any direct exposure. What's the status there?
So let's take one at a time. Etsy, not a meaningful exposure. They actually released another update saying that less than 1%, to be more specific, 0.5% of their sellers actually were impacted by SVB. And then over the weekend, they found an alternative route. So SVB was a so to speak, sweep account for them. And they found an alternative route to make sure that the payments were made to the sellers on time through a different payment provider. And so as far as the first quarter goes and as far as the year goes, there's no change to the guidance for the quarter. They don't guide to the year. And they now have a workaround around SVB. They also had about $30 million in cash as of the end of last week at SVB, but now all depositors are going to have access at some point. And that cash is less than low single-digit percentage of their overall cash position. So for Etsy, it seems like in terms of making payments to their sellers as well as their access to the cash, they should be okay. Now let's take Peloton. It seems like a very modest to almost not meaningful exposure. They have less than $500,000 in cash at SVB. Most of it or half of it will be insured, and the other insured they should have access. They also had a line of credit with them, which with the amended line of credit was not signed by Silicon Valley Bank. So really that they don't have much exposure at all. The stock had traded off, call it in the past 2 days after the ITC ban, as well as the Silicon Valley Bank news. But I think it is more of the retail trading than any of this noise created by news.
So I guess let's put Silicon Valley Bank aside then for these companies for right now,
Yeah.
Shweta. But I do want to dig into Etsy in particular a little bit more because there has been some other negative sentiment around the company as of late. We had Citron Research issuing a short call on the company, talking about alleged counterfeiting or counterfeit merchandise is sold on the site. We had one of your peers in the analyst community downgrading the stock recently, throwing in the towel, concerned about buying trends. How do you feel overall about Etsy right now?
So we actually had a tactical underperform on the stock into the year. And we maintained our outperform rating. Basically, our call was that in the near term, we see macro headwinds, and we think that the stock will likely be range bound or lower. But long term, we think that this is a structurally strong asset. And we continue to hold our view. We don't have the underperform rating anymore, but I still believe that the stock will likely be range bound from here. It has underperformed year to date, and we think that macro headwinds will not be beneficial for Etsy. That said, if you are a long-term investor and not playing for the next 3 to 8 months, but you're more patient with, call it a 8 to 24 month time horizon, there could be a good buying opportunity for Etsy as a stock here because they have a great management team, great execution. When the macro turns around, they should be positioned to gain share in the overall e-commerce market. They have very healthy margins and very healthy free cash flow, almost all of their EBITDA to free cash flow conversion. And they have a potential for greater margin expansion going forward. And their overall outstanding diluted stock count in terms of number of shares outstanding hasn't changed that much. So in terms of free cash flow per share, it's actually an attractive entry point for somebody who is willing to be more patient. Near term, however, because of the macro challenges that we're facing, Etsy has an outsized exposure to discretionary spend with home furnishing, jewelry, and apparel being the top 3 categories. So there's no doubt they're going to have choppy waters to face here. But for patient investors, there could be opportunities here.
Interesting. Always a good reminder on time horizon when we're talking about this stuff, because it's not all created equal. Shweta, good to catch up with you. Shweta Kajuria, thanks for clarifying. It's very helpful to get your perspective on all this stuff. Evercore ISI Managing Director Shweta Kajuria. Coming up, as the public digests the aftermath of the Silicon Valley Bank collapse, we're going to speak with our next guest on why she says this will not be like 2008. That's next. As investors continue to grapple with the fallout from Silicon Valley Bank and its collapse, our next guest says while it might have uncomfortable echoes of 2008, the situation is, of course, much different. 7-4 business and finance editor Liz Hoffman joins us now. Liz, it is fantastic to see you. I think the last time I saw you was in Switzerland, so it's good to see you here. Let's talk a little bit more about this, because I do think it is important to put it in context for folks. I mean, I'm sure you, like I, had various family members, acquaintances who are not as steeped in this stuff asking questions over the weekend about what they should do. But, you know, it is important to sort of couch this and make it clear to people that they don't need to necessarily freak out.
No, that's absolutely right. I mean, this is not 2008. I think for two reasons, which isn't to say, like you said, that this isn't going to be unpleasant and pretty humbling for a lot of people. The first is that the assets that started this entire run are not the same toxic real estate garbage that created the 2008 mess. They are, by and large, Treasury bonds, agency bonds, Fannie and Freddie debt, and mortgage-backed securities that people can value pretty easily, pretty quickly, understand, lend against, sell, etc. The other is that I think there is a chance that this goes down the banking food chain. I'm not sure there's a chance that it goes, I'm not sure there's much of a chance that it goes up it, which is to say that there was this real fire break put in behind below the biggest banks after 2008. And they're just in a much, much stronger capital position than they were.
And let me ask you, Liz, about this blanket guarantee for uninsured depositors as well as insured depositors, regardless of the threshold, however much you have here. At least one of the articles you've written, and you quote a former Office of the Comptroller of the Currency, citing potential moral hazard here, because the bank had the ability, the officials at the FDIC could have merged the bank. They had a few other options, but instead we have the feds providing this blanket guarantee, and of course that's always extrapolated into the future. Just wondering, based on who you talk to, maybe your own personal insights here, is this a problem going forward?
I don't totally buy the moral hazard argument here in the same way that I think it carried some significance and some validity in 2008. Retail depositors cannot, I don't think, and should not be expected to be bank risk managers. The Silicon Valley Bank's depositors, and your prior guest was on talking about some of these corporates that were asleep at the switch in terms of cash management. But generally speaking, the product that we're talking about, which is savings and checking accounts, they should be presumed to be liquid and safe. And if you're going to push that job onto retail depositors, then there's not like a whole lot of point in having a bank. That's why banks exist, to take these incredibly safe liquid liabilities and turn them into longer term stuff. Silicon Valley Bank was particularly bad at that, as it turns out. But I don't think the lesson should be that everyone's got to be checking their bank quarterly results every 3 months. Doesn't make any sense to me. I do think, look, you can try to merge them. And I should say there is another auction underway now. The FDIC is trying to sell Silicon Valley Bank. It might be easier this time with the backstop that you mentioned that the Fed, Treasury, and the FDIC put in place on Sunday. People I talked to over the weekend, wasn't a lot of appetite for these big guys to buy them without some kind of backstop of the government. The other thing is, there was certainly some shotgun weddings in 2008. They didn't go that well, I should note. Jamie Dimon at JP Morgan has said publicly that he would never do Bear Stearns and Washington Mutual again. And the other thing too is that the size of the hole here and the reluctance of a potential buyer to step in is largely one of the Fed's making and in the Fed's control, which is how much and how fast they continue to raise interest rates, which will hit the value of the securities that are the problem here.
So Liz, as you mentioned, you're pretty well connected and well steeped in the hedge fund community. In other words, potential buyers for this stuff. Is there any condition? You mentioned a backstop. What would be the conditions under which they would be interested? Or is there a price at which they would be interested in some of these assets?
There's a price at which everyone is interested in everything. If I've learned anything from 10 years covering Wall Street, it's important to note there are certain things that hedge funds can buy and certain things they can't that have to go to a bank. Fundamentally, the deposits have to go to a traditional bank. The loan book could certainly be bought by some private capital firms, and we understand that most took a look this weekend. Some have expressed interest in buying them. In Silicon Valley Bank's situation, my understanding is that it's a little harder than normal to separate the loan book from the deposit book because a lot of the implicit business model of Silicon Valley Bank was giving these off-market, below-market, sort of oddly collateralized loans to borrowers because they would keep their deposits with the bank. So some of that stuff is just priced in a way that it's probably easier to package the loans and the deposits together.
All right, we got to leave it there. Always great talking to you. Semaphore Business and Finance Editor Liz Hoffman. Coming up after the break, we got some big interviews on tap, and we're going to tell you what you should be watching up next. Welcome back. Looking ahead to our next hour, Rochelle Akufo going to speak with Passion Capital partner Eileen Burbidge on the state of venture capital in the wake of Silicon Valley Bank's meltdown. In-house financial services chair Maxine Waters sits down with our own Jennifer Schonberger to discuss Washington's response.
But coming up on the other side of the break, why our next guest says Silicon Valley Bank is the bear market's Enron. We'll discuss those parallels next. Welcome back to Yahoo Finance. I'm Julie Hyman with Jared Blickery. Let's check the market action as the latest headline CPI print showed signs of cooling, or at least not getting worse in February, but of course the core number coming in hotter than estimated. We'll talk more about that and the permutations, the ripple effect for the Fed in just a moment. But first, let's take a look at the markets. The Nasdaq trading at its highs of the session here. Of course, this is after a rocky few days, but now it is leading the gains that we are seeing today and might have maybe might have something to do with the bond market, but we are seeing bond yields go higher, but still well below 4% on the 10-year here. So maybe a better situation, a good situation there for the Nasdaq, which has been so sensitive to interest rate changes. Here is a look at the Nasdaq 100, and as you can see, mostly green on the screen. Just looking here, what stands out to me is Meta, which earlier confirmed that it is going to be cutting more jobs, something that's been talked about, 10,000 of them. Also standing out to me, just as I eyeball the screen here, is Alphabet. Those shares up 3.3% today. So those are a couple of the mega caps that are leading. Nvidia up 3.5%, Tesla up by nearly 3% as well. So some big gains. We continue to watch what's going on in the banking sector here. The large banks on the rise, with a couple of exceptions, including Credit Suisse, whose shares are down about 0.8% in U.S. trading. But the mega banks continue to, what we're hearing and reporting, is take market share potentially as a result of the Silicon Valley Bank fallout. And so those stocks are benefiting. The regional banks, they're all in the green. Look at that. The whole darn screen, the whole darn heat map. is green. Well, the headline numbers for the Consumer Price Index in the month of February came in line with estimates. Core inflation may still be hot enough, though, to cause trouble for the Fed. Here with the details, Yahoo Finance's Jennifer Schonberger from D.C. Jen?
Good morning, Julie. CPI coming in a bit hot, as you mentioned, on that core number, implying that inflation's still sticky, likely forcing the Fed to continue raising interest rates, but strike a cautious tone given the financial instability in the banking sector. The Fed has always said it would use its regulatory tools to deal with financial instability. Indeed, you saw that this week with the creation of a new lending facility to backstop deposits and assist with liquidity in the banking system. Their view is that the monetary policy is separate. When we look at that inflation number, the inflation number on a core basis, excluding food and energy, came in hotter than expected and higher at 0.5% on a monthly basis, year over year clocking in at 5.5%. If you look at the trend, that's a mild reacceleration in prices because it was larger than that 0.4% gain over the prior 2 months and 0.3 of a gain in October and November of last year. Now, excluding the financial instability risks, this kind of print in tandem with the jobs report likely would have put a 50 basis point rate hike on the table. Recall just last week in testimony before Congress, Fed Chair Powell opened the door to raising rates at a faster pace. The market interpreted that as 50 basis points if inflation data remained hot and we got a strong jobs report, which is exactly what we're seeing play out. But given the financial stability risks right now, the Fed likely to opt to move more cautiously and raise by 25 basis points. That is the base case to proceed with a 25 basis point rate hike from Wilmington Trust's Luke Tilley, Piper Sandler's Benson Durham, and Peter Bookvar of the Bookvar Report. As Chair Powell said, Julie, this is going to be a long and bumpy process.
Indeed. We are all bracing ourselves for that to continue. Thanks, Jen. Appreciate it. And Jen's going to be continuing our coverage of the SVB collapse, as well as everything else that's going on in terms of financial and fiscal and monetary policy. At 11 a.m., she's going to get perspective from a major lawmaker. That is, of course, chair of the House Financial Services Committee, Maxine Waters. You don't want to miss it.
And with core CPI taking up 0.5% in February, inflation remains a pain point for the Fed and rate hikes still in the spotlight, especially as concerns over the financial stability risks in the banking sector rise following the collapse of Silicon Valley Bank. And here to discuss all of this and more is Bill Smead, Smead Capital Management CIO. Bill, always great to see you here. So big picture, what's the Fed going to do given this latest uptick in CPI, especially the core services here?
Boy, I don't consider myself a Fed whisperer, but you've got them kind of caught between a rock and a hard place because they need the economy to continue to percolate along, which is percolating along for people with in the bottom 90%, not the top 10% of incomes. What we're having already is what my co-manager Cole likes to call it a rich session, right? There's a recession among rich people. Their capital has been damaged. Now their bank is threatened. These are problems for extremely wealthy people, and average folks are seeing their wages go up sharply, deservedly so, because their labor is highly valued. And it's a great irony watching. Just think of how long we went with shows like the Rich and Famous shows, with all the wild houses and et cetera. Well, now we're going to have just the opposite. The show is going to be about how much life has gotten better for average folks and how miserable it is for the rich folks.
Well, I don't know about that if we continue to see food inflation go at the rate it's been going. But point taken, Bill. I want to ask a little bit more about what we're seeing as the result of the fallout from Silicon Valley Bank, right? Because it's been really interesting, the action we have seen in other banks over the past few sessions, right? Particularly regional banks, which plunged and now are coming back. Some of the larger banks have held up better. But I suspect you probably have some banks in your portfolio. I know Warren Buffett, who you track closely, has some banks in his portfolio. And so is it going to be more costly to do business as a bank coming out of this whole thing?
Well, yeah, we own Bank America and JP Morgan and American Express, and it looked to me like foolishness for people to sell them in reaction to this, because you're right, they're just going to get stronger out of this. But I think you got to put all of this stuff into context. A bear market started in late 2021, and its purpose is to clean the investment markets of the egregious chicanery and foolishness of the prior 6 or 7 years. We had nearly free money for 5 years. And when people are allowed to use free money, they do a lot of really stupid things with the free money. Charlie Munger called it the biggest financial euphoria episode of his career because of the totality of it. And what did he mean by that? He meant that it wasn't just FANGs, it wasn't just techs, it wasn't just high price to sales stocks, it wasn't just the Beyond Meat market and the Peloton market, it was crypto, memes, IPOs and SPACs, et cetera. So what you do is we went back and looked and said, what prior markets had to clean the system, being a stock market system? And that would be 73, 74, and 0 to 03, the Nifty 50, and then the dot-com bubble. Well, the weird thing about this one is we have both the Nifty 50 bubble and the dot-com bubble at work at the same time. And Silicon Valley Bank was symptomatic of the dot-com bubble. What is going on here is free money has gotten into the hands of numerous startup businesses, and then all of a sudden the IPO window closes and everyone is going to reassess at what terms they're going to get involved in a new venture. And let me tell you, all those reassessments are dramatically lower. In fact, most of them won't happen because the endowments and foundations and family offices that used to just love to lavish money on private equity people and love to lavish money on the venture capital market, they're not going to touch a thing for a while. And the chain reaction of that is going to be entertaining.
Well, Bill, I like these historical analogs. I also like that you're going back in time and not just going back to the 2008 global financial crisis, because in my personal view, that's more apples to oranges here. But getting back to the dot-com crash, that was slow motion in a lot of ways. It took a year for the recession to onset from the prior stock market peak. It took about 3 years for the stock market to finally find its footing here. In the meantime, we had Enron play out, we had WorldCom. What can we expect in the intervening time here while we're waiting for markets to find their footing? Right.
So you hit on a great point. So the analogy is so the rhyme is so strong here that the Y2K changeover caused for 2 years all companies and all governments to buy new computers, new servers, new software, new routers, new phone equipment, new everything, right? Because when January 1 hit, they didn't want the world to stop. Well, what happened was you got to January 1, the world didn't stop, but every company had purchased every bit of technology that they were ever going to need for like 4 or 5 years. Well, fast forward, we closed the economy in 2020. We literally shut the economy down. The federal government spent between two administrations about $8 trillion of borrowed money to prop up the economy while we had it closed down. And what did people do? They put up a home office and they put in a bunch of technology stuff. And if they were a business, they put technology stuff in to do a Zoom call like this and all the things that go with it. And so what that did was it just created an additional 2 years of legs to the mania that Munger was talking about, the same way Y2K extended the dot-com bubble. And by extending it, what you do, I'm not Catholic, but I think if you're a Catholic, the penance has got to equal the sin, right? And so we think we're at about halftime of this bear market.
So, Bill, if I can dig into that a little more, where's the penance coming from? In other words, What's failing next? Are we going to see more bank failures, do you think? Are we going to see, it sounds like you think startups are going to go under. Do you think VCs are going to go under? Do you think private equity firms even are going to start to have problems? Where are you looking for the next blow up?
Well, it's a great question. The first thing I thought of is what I don't think anyone's mentioned, right? It's so funny. The first thing I thought of is, okay, when a startup does get funded, what do they spend money on? Where does that money go in the early stages of a startup during those years when all of them have no profit, right? They're growing their revenue, but they have no profit, profitless growth, right? So who are their vendors? Who do these companies spend money on? And who was Silicon Valley Bank and Signature Bank were very intertwined with the movement of that money. Where did it go? It went to web hosting. It went to online ads at Facebook and Google and Apple and Amazon. It went to Amazon Web Services. It went to Microsoft and the other software vendors, et cetera. No one's even talking about that. We're shutting down this huge ecosystem of startups and IPOs, et cetera, and they're treating these companies like there's not going to be any fallout at their end. It just, to me, it's absolutely remarkable. They're all web hosted. They're all using cloud services. It's like people have been bidding up Amazon as a safe quality stock, and one side of Amazon is a profitless e-commerce business, and the other side is a cash gusher that has customers dropping like flies.
Well, I mean, but you're not suggesting Amazon's going out of business.
No, not at all. What I'm suggesting, and the reason I like bringing up 73, 74, at the end of 1972, Coca-Cola was trading at 60 times earnings, and Disney was trading at 80 times earnings at the end of 1972. When I came into the business in 1980, those stocks were single-digit multiples. Now, you tell me, if we go through a 3-year bear market, is Amazon going to make it out of here with a 60 multiple?
It seems like if they really,
no.
I think that's a no. I think that question was a bit rhetorical, Bill, but yes, I think that's something that investors should be looking at if they're thinking it's going to recover in a shorter period of time. We got to leave it there, Bill. Yes.
Yeah. Well, one more thing on Facebook. In normal times, they make fun of businesses that are laying people off. The old term was you can't cut your way to prosperity. So here we are halfway through a 3-year bear market, and they're bidding the stock up that's laying people off as if you can cut your way to prosperity.
It does seem to be very popular to cut these days, Bill, but your point is well taken. We could spend a whole hour with you, but we got to go. Bill Smead, Smead Capital Management CIO, great to catch up with you. Thanks for the historical perspective and much more. Appreciate it. We are looking at one trending ticker today. That is Bunge, the crop company. The shares are surging by 14%. Guess what? It is going into the S&P 500. It's going to replace Signature Bank, the bank that, of course, was closed by the federal government this weekend, the bank that was crypto-oriented. And so when you see this happen, if there are index funds, if there are ETFs that track the S&P, guess what? They got to add Bunge. And that's what it looks like investors doing ahead of that happening today. It's effective, it looks like, prior to the open of trading tomorrow. So that's why you see all this movement in the stock today. Well, coming up next, we're going to head down to Austin, Texas, and talk to that man right there. That is Brad Smith, my co-pilot. When he comes back, that is, we're going to talk to him about what the zeitgeist is looking like in Austin this year. We'll be right back. Let's do a quick check of the markets now, sponsored by Tasty Trade. An upsurge in the major averages. And guess what? I just checked in the S&P 500. The 10 largest movers today on a percentage basis, all financial services. It's a mix of the regional banks like First Republic, which is up some 50%, and also some other regional banks and financial services companies that are helping lead the gains. The Nasdaq leading the gains among the major averages. It's up by nearly 2%. And our market check brought to you by Tasty Trade. South by Southwest is undergoing. It's on now. It's one of the biggest yearly events for the tech industry and startups. And now most conversations at the half conference, half festival event start with SVB in the wake of the collapse of Silicon Valley Bank. Let's get to Yahoo Finance's Brad Smith. He's attending. He's in Austin, and he's trying to get a sense of where VCs are putting their money, or are they putting their money anywhere right now? Like, I wonder if there's been sort of a freeze, even though there's a lot of pitching going on, as you told us yesterday. I wonder if VCs are being more careful right now.
Yeah, they indeed are, Julie. And this morning, as we're posted up on what is the most musical part of Austin, Texas, on the infamous 6th Street, it is not music to anyone's ears who's checking in on what's taking place within this banking crisis and SVB specifically. But we've been able to get the vibe of some of the VCs here that are at South by Southwest. And one such VC who we spoke with, Josh Wolf, who is the managing partner and co-founder at Lux Capital, he told us that the vibe here, and for VCs specifically, the pendulum is swinging on the FOMO days of venture capital here. Now, one of the things that he did tell us is that they are still being extremely judicious about the companies that they invest in. They're looking across everything. Is your model recession resistant? Is your technology actually something that's innovative, or is it iterative? And so within all of that, he gave us a little bit of what he expects within this reversion that VCs are tracking right now. And here's what he had to say.
I think some of it is a natural reversion, what we call the excess of excesses that were occurring in recent years. I think some of it is also people just saying, wait a second, this has been absolutely crazy, let's have a reset. But I do think that the next few years are probably in venture capital going to be the best vintage years in the past decade. Why? You've got lots of firms that know what they're doing, and their reputations are rising, and their access and their networks are growing at a time when prices are coming down. And when prices go down and valuations get lower, your future returns, if you're right or lucky, can be very high. So very optimistic for the future of venture.
And so even within this, he went on to say that I think that there's going to be a lot of pain for the next 2 years, and that most likely we're going to be in the equivalent of a Q3 of 2000. Now, he went on to really lay out the playbook for some of the venture capital community out there, and this could have big impacts for a lot of the companies that are trying to get their pitches in front of the rooms with the dollars that are dispensable here. But what he eventually went on to say was that you had 2 years of range-bound high volatility markets that were declining. You saw the rise of long short hedge funds. You think of names that we know today like Bill Ackman, Dan Loeb, even Jim Chanos, and you're going to have a next generation of players that are great stock pickers on the long side and the short side, and you're going to see a great new generation of venture investors that have really high governance and really high expectations for their companies. And so what it boils down to here, and what so much of the conversation has really been among the VCs as well as those companies that are going through their pitches here to the money that is disposable, and your company, not just over the next 2 to 3 years, as even Josh had acknowledged the fact that we are probably staring at the most telegraphed recession that he can remember, but at the same time, looking even through those next 3 to 5 years, what's the leg of growth? What's that opportunity? And generative AI, that did come up in our conversation, but he's looking for the companies that have language learning models and are able to build on top of and monetize their models even more so from here. So that's really kind of the connection or the intersection of what's taking place in the conversations between VCs and a lot of these startups that have made their way here to Austin, Texas for South by Southwest as well.
Brad, really interesting there, because you were talking about the historical analog of the dot-com bust. We were just talking about that with Bill Smead here, and so in order to look towards the future, sometimes you have to look at the past, learn some lessons. And I'm glad to hear that AI isn't dead just yet, because we had a banking crisis and forgot to talk about it for a week. Just wondering, in general, have we put the pandemic behind us, and are these companies really looking towards the future when it comes comes to just through that lens, which is the past is the past. We've emerged from the pandemic. We have this new economic situation in place. How are we going to manage it?
Yeah, I think for what we've been able to experience here, there is still so much investment that needs to be done, whether it's in the housing front. We've been able to speak with Icon 3D Homes, is what they build, and they've taken in about $450 million in funding to this point in time. Similarly, so for where we spoke with Eve Mobility, around the same that they've been able to take on in funding, and it's right now how they're deploying that cash to really continue investing in a lot of what is still unproven at scale. You think about being able to take an air taxi from JFK to downtown Manhattan. That's what Eve Air Mobility wants to make happen for about $100 for customers there. And then on the other side, you've got Icon 3D Home Building that wants to be able to cut down dramatically by about 2 to 3x how much people are able to build a home for through 3D printing. And so with all of that, there's still heavy investment that needs to take place. It's how proven and how much at scale they're going to be able to build out some of those ambitions that I think a lot of the VCs are going to be paying close attention to, and they have been thus far. I mean, even within Icon, they have taken funding in from Tiger Global Management, and I was able to ask them a few questions just off camera about that. But it really is looking into some of the more proven and still where regulatory red tape might need to be cut down on the aircraft mobility side if you're taking an air taxi somewhere, where that's going to be able to provide even more opportunity for future growth, but also they're still going to need some cash, some capital to be able to ramp up the production and a lot of the vertical integration that many of them have taken on in order to fast track their own growth at this point in time too.
Yeah, it comes down to that cost of capital, but it looks like a lot of disruption at our feet here, just waiting to take place. I've still been waiting for some of these inventions for decades, so glad to see that. Brad Smith down at South by Southwest. Switching gears, crypto's rally is back on after February's cooler than expected inflation report. Bitcoin breaking the 26,000 level threshold amid worries over the regulatory environment and risk in the banking system. Its price action now suggests a bullish streak ahead. Let me get to the Wi-Fi Interactive. I don't know how cool we could say this morning's inflation report was, at least on the services side, but nevertheless, I've been saying for quite a long time, several months now, that Bitcoin has been leading the way for risk markets on a lot of these reports, Julie, that deal with inflation, the big jobs report, Powell standing up in front of people and opening his mouth. All of these things seem to hit Bitcoin disproportionately more. And now we have it bumping up against former price resistance at the $25,000 level. I could go into some technical analysis here, but any comments on the great crypto rally that we had?
Yeah, I mean, two comments. Mm-hmm. We spoke to two guests today who cited crypto as one area that still could cause risk in the system, right? Which I thought was quite interesting. Unprompted, not necessarily surprising that Bill Smead would say something like that because he follows Buffett and Munger closely, and Munger has been very anti-crypto. But we also heard Matt Miskin of John Hancock mention that would be an area to focus. So price action aside, that's something I think people need to keep in mind. The other thing that I find absolutely bonkers bizarro is that people seem to be flowing into crypto over the past few days because they said, well, this was a failure of the banking system. DeFi and crypto is now, this solidifies our view that that's the answer, which is just a little bit confusing to me, shall we say.
If Gary Gensler has demonstrated anything, it's that crypto is under the big thumb of the United States regulatory agencies, at least going forward. I think it's going to be heavy-handed in that regard. I will say this. In this part of the business cycle where we see the Federal Reserve having hiked already a lot and now just beginning perhaps to step on the brake or at least lift its foot off of the brake here, at this point of time is when gold usually takes off. And so we've seen gold futures perk up over the last couple of days. Here is a year-to-date chart. Let me just get a longer term. Here's a one-year chart. And you can see this latest liftoff is only a few days worth, but really occurring with the same fervor that we saw interest rates move over the last day in reaction to what the Fed is doing. So if the Fed and the other federal authorities here are creating moral hazard by guaranteeing all deposits, and we're seeing gold perk up, and Bitcoin is right there with it, maybe there are some parallels there. But I will say historically, this is a time when gold starts rallying the business cycle. People are saying, why was gold not rallying last year? It's because the Federal Reserve was way too hawkish. And historically, and we can watch this pan out over several cycles previous, that does not happen.
Interesting.
Anyway. All right, coming up next, our next guest doesn't recognize the handling of SVB as a bailout, and we're going to discuss it up next. Welcome back. Many are avoiding categorizing the government's response to SVB and Signature Bank's failures as a bailout. But by stepping in to protect depositors, some fear a moral hazard has been raised that could only encourage financial betting. William Cohen, founding partner of Puck News, joins us now. Thank you for joining us here today. And I get the arguments. I could see on both sides here. It's not a bailout because depositors shouldn't have to read their bank's financial statements, maybe, but also this sets future precedent, or sets a precedent for the future, which could be expensive. So how do you fall in this?
Yeah, I mean, let's be clear. The bank's shareholders and creditors the shareholders have definitely been wiped out. The creditors probably will be wiped out. There was a major policy shift, right? Change. We don't know how long it'll stay in effect, but before this, anybody with a deposit, a bank account of more than $250,000, they'd stand in line and see what happens, and it might take some time before they get, 90% of their money back. Now, they don't have to stand in line, they can get their money back. So what you do is you helped a lot of people who banked at Silicon Valley Bank, which is a good thing. You help them get their payroll, small startup companies get their payroll back. But you also helped people like, Andreessen Horowitz, who probably had something like $1 billion at Silicon Valley Bank, who should have done their homework, right? Who should have If you're going to put $1 billion into a bank, for whatever reasons that they do that, which is a very interesting thing why so many of these VCs did do business with that bank, then you should do your homework about the asset side of their balance sheet. And if you don't, you should suffer some consequences. But I guess we'll have to sort that out later, because the most important thing was restoring confidence, and I agree. But at some point, people have to be held responsible for their poor decisions.
Well, and maybe just sort of examine how that works. It's illustrative to go back to the financial crisis when you and I got to know each other, which you covered that in detail. And that's when the concept of moral hazard was really talked about a lot. That are you encouraging future risk-taking behavior or absolving responsibility in some way by coming in and taking the actions that you're taking? And so maybe let's go back and look. There was a lot of talk about moral hazard at that point in time because of bailouts. Did it encourage future risk-taking behavior, what the government came in and did in 2008?
Well, you have to look, it's really kind of a interesting continuum. If you start with long-term capital management, was in the late 90s, so a decade before the financial crisis. The Fed did not step in to save long-term capital management. The Fed stepped in to ask the Wall Street banks who were doing business with long-term capital management to step in and solve the problem that was long-term capital management before it became a contagion, before the confidence was wrecked and everybody started freaking out. So the banks did do that, with the notable exception of Bear Stearns. They did not contribute to that quote bailout. That was like $300-400 million per Wall Street bank to save long-term capital management. Then come 2008. Literally 15 years ago, the government steps in and for the first time ever rescues an investment bank, Bear Stearns, by agreeing to, take $30 billion of the assets that JP Morgan Chase didn't want and put them in Pine Street Capital or whatever it was. And then JP Morgan bought the rest for $2 a share and then $10 a share. So, creeping government underwriting, if you will, of the financial system. And I think we just crossed another line, for whatever reason, over the weekend by insuring these deposits beyond $250,000. I get why they did it. There was a lot of people's livelihoods at stake. I get that. It was in a certain ecosystem. But, you've now also saved the Andreessen Horowitzes of the world $1 billion. And I don't know why we did that.
It's interesting to talk about these historical analogs today. In the global financial crisis, you mentioned Bear Stearns failing. I think that was March. Also, the Federal Reserve slashed rates in January as a result of Jerome Kerviel and the SocGen losses there. That was a European.
That's a name I haven't heard in a long time.
We're going to relive the GSC right here at this desk.
Well, the slashing of the interest rates actually began after September 11th. They went from about 6% down to 1%, and that encouraged what we saw from 2009 to 2022 with quantitative easing and zero interest rate policy. We saw a mini version of that between after 9/11, and that resulted in some extent what happened in 2008. And now we're seeing a version of that, only kind of bigger, although it's hard to imagine bigger than 2008. But we are seeing the consequences now of the zero interest rate policy at the Fed level for these last 13 years.
You've mentioned Andreessen Horowitz a couple times, or the other big VCs, big wealthy VCs, that this is viewed in part as a bailout for them. You've long been someone who has reported on these sort of echo chambers of wealth and power, right? And I wonder what you think the consequences of that's going to be, sort of from a cultural perspective or from a policy perspective going forward.
We have to see. Policy takes a long time to implement and get created. I think the short-term consequences, as you guys have been reporting, is, are people losing, again, confidence to some extent in the financial system, all right? And that shows up in places like Bitcoin, which is, surged in recent days. I mean, kind of in a surprising way, as you just said, Julie. And I'm not sure I get it, but I think the financial system, is safe and secure. This is not 2008. This is the Silicon Valley bank ecosystem the Signature Bank ecosystem, that was more crypto. There were several crypto banks that sort of went under in the last week or so. Silicon Valley Bank was a very unique ecosystem, and why people did so much business with that bank really needs to be examined. And of course, their own effective lobbying to get themselves exempted from the Fed's stress tests,
Right.
which probably would have picked this up. So they kind of did it to themselves to a certain extent, and whether it was exacerbated by venture capital firms asking their portfolio companies to take their funds out of Silicon Valley Bank, I mean, it had to start with a loss of confidence. It had to start with a bank run, just like it did with Bear Stearns and Lehman Brothers. I mean, the same thing happens all over and over again. The banking system is based on confidence. Confidence is lost. It's gone. You can't get it back. And when you borrow short and lend long, les jeux sont faits, as the French might say.
Yes, the jig is up. All right. Thanks so much, Bill Cohen. Appreciate it. Founding partner at Pug News. Great to catch up with you, even if it's, not for the best of reasons. But it's good to see you and get your perspective.
And you.
Coming up, Boeing's deal with Saudi Arabia may be bigger than first imagined. Yahoo Finance's executive editor Brian Sozzi shares the latest on the multi-billion-dollar deal after he talked to the company. We'll be right back. Boeing has landed a big deal with Saudi Arabia. The aerospace giant securing 787 orders from Saudi Arabian Airlines and Riyadh Air. Yahoo Finance's executive editor Brian Sozzi has the latest, and you had a chance to talk to them also. For a second, I thought it was 787, but no, it's 787.
It's a 787.
But talk us through the details of this order and why it's important.
Yeah, just off the phone with Boeing CEO David Calhoun, talking a little bit about this deal, which he's telling Yahoo Finance is significant. He says it could lead to the creation of 160,000 jobs over time as they build these planes. Overall, total order book between Riyadh and the other Saudi airline involved in this deal up to 121 787s. Total value based on the listing price of one Boeing plane at about $340 billion, $40 billion, or about $340 million. So total value overall, almost $40 billion over the lifetime of this deal. And In addition, I'm sure you talked about today as well the warnings from a United Airlines. Delta came out here this morning, backed its guidance. Calhoun telling Yahoo Finance that demand is strong and significant right here. And you go back to what Boeing reported coming out of the fourth quarter, backlog, commercial airplane backlog, over 4,500 planes. So maybe there's something to it.
And Saz, can I direct everybody's attention to the Wi-Fi Interactive, where I have a 5-year chart on Boeing right now, and this will include the high, the absolute high, all-time high before the 737 MAX troubles. A little technical analysis says we're just kind of breaking out of this downtrend here. Is the worst behind them with respect, and the 737 MAX problems were compounded by problems with the 787 and deliveries and clearing FAA hurdles. Is this in the rearview mirror, do you think, for the company?
Well, I remember covering Boeing under former CEO Dennis Muhlenberg. And in the early part of that chart, you can see he was very focused on cranking out more planes, driving the stock price up via very aggressive stock buybacks. And we see how that ultimately ended for the company. I think Calhoun continues to try to turn around the company, but it really hinges, guys, on the supply chain. Can they get the parts they need to start delivering those 4,500 airplanes? Just my sense coming off this call, it remains a work in progress, but again, telling us that demand is strong.
Well, and not just supply chain, but obviously the attention has been on quality control at the plane maker as well. That was the source of their issues. And, over the past couple of years, it felt like it was really fits and starts. It did not necessarily feel like that they had their hands around the issue. There were still a couple of reports coming out with some issues on that front. So
yeah, they do have more work to do. And then, of course, the other angle to this, of course, is U.S.-Saudi relations. And just in the time we were able to spend with them, said the working together, it seemed to all come together and work. There was cooperation, but again, that's a lot more here. Different discussion for a different day.
Yeah, and oil prices are not volatile, so not too much controversy there at least. Thank you for that, Brian Sazi. All right, coming up in the next hour, we're going to speak with the House Financial Services Chair, Maxine Waters. You don't want to miss it. We'll be right back. Welcome back to Yahoo Finance. We're looking at a market in rally mode today. You can see the Nasdaq up 2.2%, the Russell 2000 up 3%, everything else in the green, at least on the left-hand side of your screen. And I want to check inside the market. All 11 sectors of the S&P 500 in the green. Staples taking up the rear. That's up less than 1%. In the forefront, financials finally bouncing back in a decent-sized way today, up almost 3%. Communication services up 2.5%. Energy up over 2%. Tech over 2%. Materials over 2% as well. All of those outperforming. And taking a look at some of our leaders here, KRE, that's a regional bank ETF. That's up 7%, followed by Bitcoin, followed by SOX. That is the Philly Chip Index, meme stock. So you can see the fringier parts of the market attracting some money today. And let's take a look at that regional bank sector. And here we see a lot of names. Let's take a look at the biggest one. FRC, after being down, cut by about 2/3. That's up over 50% today. So is PACW, WAL as well, right up there with it. So that's where the action has been over the last few days. In the regular banking sector of the big banks, Wells Fargo up the most, up about 5%. And we have been talking about some of the other areas of the market. This is our components list. We can see that there's a lot of movement in the disruption space. Shopify and Square getting some love here. The Block company getting some upside to 5%. Coinbase up 8%. And since we're talking about crypto, let's take a look at crypto here. Bitcoin up 15%, had cleared 25,000. Let's take a look at a 5-day chart here, and we're knocking on the door. 25,000 is that big mark. I think it got to it very short term, or at least on a short-term basis, but that's going to be the level that I'm watching. Stay tuned next. In the next hour, Rochelle Akufo going to be chatting with the future of venture capital in our next hour with Eileen Burbidge. She is a Passion Capital partner, and we're going to be right back.
Got some big interviews on tap today on Yahoo Finance. House Financial Services Chair Maxine Waters is going to talk to Jennifer Schonberger in the next hour to discuss lawmakers' response to the collapse of SVB.
And Rochelle Akufo also speaking with Passion Capital partner Eileen Burbidge on the state of VCs.
Plus, stay tuned for our 3 to 5 p.m. show. Dave Briggs and Shauna Smith will speak with Kevin O'Leary. You don't want to miss that. We continue, of course, to track headlines and all of the fallout from SVB. Among other things, the Wall Street Journal is now reporting that in addition to the Federal Reserve, which we know is probing the collapse, trying to figure out what happened, it looks like the Department of Justice and the Securities and Exchange Commission are now joining in on that. And then there's a report as well that Moody's is downgrading the whole U.S. banking sector.
Yep, Gary Gensler and co. and everybody else got their work cut out for them, I would say.
Yes, indeed. All right, we've got all of this and more coming up on Yahoo Finance. So it's going to be discussing all of this. Rochelle Acuvo's got you for the next hour of trading.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acufo, and here's a look at what I'm watching this morning. Stocks jumping as financials rebound after the collapse of Silicon Valley Bank. Attention turns to the role of lawmakers now in preventing more contagion. We'll speak with the House Financial Services Committee Chair, Maxine Waters. And headline inflation comes in as expected, but the Fed's preferred gauge lands hotter than forecast, complicating those tightening plans. One investment bank now seeing a rate cut as a genuine possibility. And startups, founders, and the wider tech ecosystem remain a focus after SVB's failure. We look at where we go next with a woman many call the queen of tech VCs. Don't miss our conversation with Eileen Burbidge coming up this hour. But first, let's check in on those major indices. As you can see there, just slightly off session highs, but still off to the races for the major indices. The Dow, they're up almost 400 points on the day, about 1.25%. The S&P 500 also seeing strong gains. They're up 1.7%. And take a look at the tech-heavy Nasdaq. Tech really driving the gains here today, up more than 2% on the day, up about 225 points. Let's also check in on what we're seeing with the Treasury action there, because we are still seeing the VIX pointed in the opposite direction. And as we're seeing with the Treasuries here, some pullback as we're seeing the more yields now coming in, especially for the short term. We've got the 5-year, they're up more than 5.5% on the day, really rallying today. The 10-year up more than 4%, and the longer term 30-year up almost 3% on the day as well. Well, the latest consumer price index data, or CPI, dropped this morning in the midst of concerns over the banking sector, of course, following that sudden failure of Silicon Valley Bank. Now, this much of the focus from investors then being glued to banks leading into today's CPI report. And of course, while the headline figures came in line with expectations, showing signs of a slowdown with inflation coming in 6% year over year. But when taking a look at the core inflation data month over month, it shows that the Fed still has its work cut out for them regarding taming inflation. As one person tweeted, with a 0.5% month over month increase in core CPI, US inflation remains hot enough to further complicate the path forward for the Fed as it contends with 3 bank failures and broader concerns about financial stability. While uncertainty still remains around the Fed's path for rate hikes as they contend with inflation and financial risks, their investors look to gain more clarity in the next FOMC meeting later on this month as the fallout of SVB unravels. Well, let's turn now to Yahoo Finance's Jennifer Schonberger, who has more for all of us on that fallout from SVB and, of course, the future for the U.S. banking system. Hey, Jennifer.
Thank you, Rochelle. That's right. With everything that's happened with the failure of Silicon Valley Bank, all eyes are turning to Washington on what happens next. And with that, I want to welcome in the top Democrat on the House Financial Services Committee, Ranking Member Maxine Waters. Congresswoman, welcome to the program. Thank you so much for being here.
Okay, thank you for having me on this morning.
You're trying to get to the bottom of what happened with the failure of Silicon Valley Bank. And just a few weeks before the bank's failure on Friday, we're learning that CEO Greg Becker ended up selling out of stock and stock options and profiting upwards of $2 million. My question is, when you look at what has happened, how much of this is a lack of rules that were in place versus mismanagement?
Well, first of all, the rumors that are circulating about the stock sale, we're certainly going to take a close look at. It may need to be investigated. And I also understand that there were bonuses that may have been given out early. I don't know that to be fact at this point, but we're going to hold hearings as soon as we possibly can and unravel a lot of what we understand happened. But this is all about regulation. And this is all about the fact that at some point in time, there was great advocacy for making sure that the regional banks and the smaller banks didn't have to comply with some of the rules that perhaps would not have allowed them to get into this situation because there would have been stress testing and more oversight and more watching of what was going on. And I certainly think all of that needs to be tightened up.
Congresswoman, do you think, given these reports we're hearing about bonuses, as you alluded to, the potential for executive compensation clawbacks should be on the table?
Absolutely. And as I said, much of what we're dealing with now relative to stock sales and bonuses by top management is rumor. I don't have any facts on that. But we're going to investigate. We're going to have our hearings that will begin to open up what really took place. And everything is on the table at this point.
You said that this is a failure of regulation, of lack of rules that were put in place. What rules do you think need to be put in place to prevent against this? We know the Federal Reserve is conducting an assessment of what happened with the failure of this bank. We know that the head of supervision at the Fed is reassessing capital requirements. Should there be more stringent capital requirements, liquidity rules for small to mid-sized banks, and stress tests on a yearly basis versus every other year?
Yes, what you're alluding to or what you're talking about is what basically we thought we had in place with the Barney Frank, work that was done in order to ensure that we were giving, rules or making rules that would make sure the banks were safe and secure. As you know, there was legislation that was promoted basically by the Republicans, and a bill that was signed off on by Trump, who said that, they were absolutely pleased that they were deregulating. And I think that is something that really has helped to cause a lack of the kind of oversight, because now the flexibility was there and was given by this legislation to ensure that they didn't have to follow the rules of the bigger banks. And so some of them were trying to protect the regionals and smaller banks and saying that, we were crippling their ability to be successful with the rules that were too tough on these regional banks and smaller banks. And so that legislation was promoted by the Republicans and signed off by Trump in order to relieve the regional banks and the smaller banks of the kind of scrutiny that was needed in order to keep an eye on them.
Should that be repealed?
Oh, absolutely. I think that should be. And I'm not trying to advance the entire agenda that should be taken up to ensure that our banks are as safe as we can make them. But I do know I was involved in that fight, and I led the opposition to that fight. And so I'm very much aware of what took place when we relaxed the rules, when we gave the Fed and others an opportunity to follow the advocacy that was being promoted by Trump and the Republicans. And so I'm absolutely sure that that should be repealed.
In your briefings and conversations with the Federal Reserve and the FDIC leading up to the emergency action that we saw taken, what indication were you given that Silicon Valley Bank, a middle-sized bank, rose to the level of systemic risk that required backstopping all the deposits in the U.S. financial system?
Well, first of all, let us take a look at the Silicon Valley Bank. They was the go-to bank for startups, and they were not diversified. They absolutely spent a lot of their energy, time, and resources in supporting the startups. And as a matter of fact, one of the interesting things is that 90% of their depositors were uninsured. And so one of the things I'm going to be looking at, and others will be looking at, is what role did any of this play in bringing them to the point where the bank was in collapse? One of the things that I do know is as we deal with inflation and as, interest rates have to be increased, you have to play that against the bonds and securities that were held by the bank and what they were worth. And what they discovered was that those were securities that had low interest rates, and now the interest rates had raised substantially. And so they couldn't sell off those securities unless they took a big cut, and they did. They took a big cut and discounted, those assets that they had because of the interest rates had changed. And so that was one of the problems with what took place.
Along with Silicon Valley Bank's failure, we saw Circle stablecoin break the buck. Their management has been calling on Congress urgently to pass legislation to regulate stablecoins. I know that you have been working with Chair Patrick McHenry on stablecoin legislation. Where does that legislation stand now, Congresswoman? How far apart are you on that?
Well, actually, I believe the legislation could be passed when we get back to Congress in a few days. We had just about solved all of our problems. The only thing that interfered, I think, with its passage was the anticipation that the House was going to change and it was going to be in the hands of the Republicans, and they should take charge rather than those of us on the Democratic side that they believe would not be in charge, and I would not be the chair anymore. And so I think it's ready to go. And we had resolved most of our issues, and I think we can get it done.
So we could see passage of this bill within the next month or so, next couple of months, by later this spring? What's the timetable, you think?
Oh, I'm not going to give you a timetable because there's always uncertainty in negotiations and the way that things get done in Congress. But I want to tell you that I'm focused on it. Mr. McHenry is focused on it. We have a bipartisan effort that we put on it, and we're going to do it as quickly as we possibly can.
Congresswoman, have you spoken to Chair McHenry on the Silicon Valley bank situation and what should be done here? He seems, based on his statements, to be a bit more reserved that the regulations that are currently in place should be enough. He had some misconceptions about social media and the role that played perhaps in this crisis. But have you talked to him? How do you see working with him on this issue?
Well, as you know, when the facts come out, I do believe some of those who are reticent about the legislation that may be needed are going to change their minds. When the facts come out and they take a look at how the bank operated, and when they take a look at what that balance sheet was that should have been known, that their assets were not as valuable, when they look at all of this, I don't think that there will be any politics about, I think it's all right, and I think it's the internet, I think it's Twitter. I think all that stuff is going to go out of the window because the facts are going to prove that we need to tighten up on the regulations, and that the legislation that allowed the regional banks and the smaller banks not to have to comply with the tough rules of the larger banks is going to change things. And so I'm optimistic that we're going to get it done. And those kind of comments do not bother me at this point.
And one last question for you, Congresswoman, switching gears a bit on the debt ceiling. I know you sent a letter to Chair McHenry urging him to take this matter seriously and hold a hearing. Have you heard back from him on that? What are you hearing? What's the latest from your Republican colleagues on raising the debt ceiling?
Well, we are working very hard to get them to understand we've got to raise the debt ceiling. And as you know, Yellen, our Treasury Secretary, has been maneuvering and figuring out how she could pay bills as they come due, but that's going to be over by June. We've got to raise the debt ceiling. And I don't believe that my Republican colleagues have moved quick enough since we've been back in session to focus on the fact that we cannot default on the debt. We cannot close the government down. This is serious, and I don't think they're taking it seriously enough at this point. And the way that they rolled out legislation all about socialism and those kinds of things is a waste of time. We've got to focus on raising the debt limit and being credit worthy so that we can keep our country going in the way that it should be going. And so we're going to press hard. I'm pressing hard, and I want them to realize that this has got to be done quickly.
Congresswoman Waters, want to thank you so much for your insights. So appreciate it. Hope to speak with you again soon.
Well, you're so welcome, and thank you for having me on.
That's Maxine Waters, ranking member of the House Financial Services Committee. Rochelle?
All right, thanks so much. Jennifer Schomburger there, great stuff. All right, also out this morning, CNBC is reporting Moody's Investor Service downgraded the entire banking system to a negative outlook from stable, citing a rapidly deteriorating operating environment. It added that banks with unrealized losses are under particular pressure. Now, yesterday, the credit rating agency put 6 U.S. banks on review for potential credit rating downgrades. Signature Bank was also given a C rating by Moody's yesterday as well. Meanwhile, in tech, Meta announced another round of layoffs here this morning, eliminating 10,000 roles within the company and closing 5,000 open roles that haven't been hired yet. So we'll have more on that for you after the break. Stay with us. Meta announced another round of layoffs this morning, eliminating 10,000 roles within the company and closing 5,000 open roles that haven't been hired yet. Joining us with more is Dan Howley. Hey Dan, what's the latest?
That's right, Rochelle. We're seeing those 10,000 layoffs coming in the coming months. So basically, workers have been told that there will be jobs eliminated by tomorrow. The recruiting portion of the company should know who is staying and who is going, but then the actual tech team and business side, they'll find out in April, and then the coming months. Some people won't even find out until the end of this year, though. So, not a great way to boost morale at a company that already has had a layoff of 13% of its workforce. And, this is one of the firms that really kind of shot up its ranks during the pandemic. They bolstered the number of employees on staff, and now they've cut that essentially back entirely. They laid off that 11,000 employees in November. Now they have the 10,000 that are going to be coming now. So they'll have laid off effectively 21,000 people in just a few months. So this is something that Mark Zuckerberg, though, says is part of the year of efficiency push that they're doing, where they say, and he says this repeatedly in his post about it, wants to flatten the organization's structure. They want managers to have at least 10 than 10 direct reports. They also say that people should start to meet in person whenever possible. This is all coming as they continue to plow money into the metaverse. They had spent $10 billion on it in 2021, $13 billion in 2022. But the big thing, I think, outside of the layoffs that he mentions in this is he specifically calls out AI as something that they continue to invest in and making it one of their bigger pushes. So it seems as though the company's shifting from metaverse first to AI first. And look, they changed the name of the company to Meta because of this metaverse vision. But now with the digital ad sales slowing, interest rates on the rise, it seems as though they're changing their tune from something that's more risky to something that Wall Street is clearly more interested in, and that's the AI aspect.
I mean, certainly ever since they changed that name to Meta and had that focus, we saw how the company has performed. So this pivot, though, interesting, especially with this year of efficiency, potentially more layoffs ahead as they continue to tighten. And of staying in tech, we're also hearing that Uber and Lyft also scored a major victory in California.
That's right. They won their latest court battle over Proposition 22. Previously, the proposition, which was voted on and approved by voters by 58%, was overturned in an appeal. And now Uber and Lyft are seeing that will eventually be overturned. And so effectively what this means is that the companies will continue to be able to refer to drivers as gig workers, not employees. They'll receive limited benefits, but not what full-time employees would have. Previously, a judge had said, look, we have to throw out all of Prop 22. It just doesn't work constitutionally. But now a 3-judge panel had said, no, we can leave it in place. There's only certain aspects of it that need to be pulled. Don't expect this to be the last you'll hear of it, though. It's expected to go all the way to the California Supreme Court. And this is really something where, drivers, driver unions say that Uber and Lyft, as well as other gig worker companies, are really just essentially taking advantage of them. And they say that they're not getting their fair share. Uber, Lyft, the other gig economy companies, though, they say that, this is a means for workers to get paid and work on their own schedule rather than have to be to abide by a more formal kind of work setup. And so you're going to continue to see this kind of back and forth. I don't expect it's going to end anytime soon. There are other states where Uber and Lyft are working to try to push this kind of legislation forward. So we'll have to see how California shakes out before we see what other states end up doing.
So if this had gone differently in California, then what would have been the outcome for these gig workers?
Yeah, they would have been considered regular employees, right? They would have gotten firm benefits. They would have gotten sick pay. They would have gotten full medical, whatever an employee of any other business would have needed or been assured under California law. And so now they're not getting that. They're getting kind of obviously a cut back version of that. They don't get the kind of sick pay that they may get in California, no guaranteed days off that they might get in California, and they may have gotten better pay. Uber and Lyft argue that they would have had to spend millions and millions of dollars trying to rework the system to ensure that they have enough in place to get workers to be full-time employees. And so that's why they don't want to do that. It also doesn't hurt that it saves them a good amount of cash, not having to pay into those benefits as well. And, as one of the largest economies on earth, and especially one of the largest driving communities in the U.S., it's clear why Uber and Lyft are pushing California so hard and not in other states. They've done battle in other states, don't get me wrong, especially in New York, where they have been fighting the state there in the city as far as what workers should be paid. But California really has been the big battleground for those companies.
We'll be keeping an eye on that space, especially if we see as it goes up to the Supreme Court potentially. Dan Howley, thank you so much for that update. All right, checking in on the markets here, sponsored by Tasty Trade. We're seeing the rally continuing here. The Dow now up more than 470 points, up 1.5%. The S&P there up more than 2% on the day. Tech-heavy Nasdaq there up more than 2.3%, driven especially by Apple, Microsoft, Amazon, Nvidia's gains, Google, as well as Tesla. We'll be keeping an eye on that for you as we head into the noon hour. All right, coming up, what to expect from the Fed moving forward following today's CPI data. We're joined by an analyst from William Blair to discuss what's next for Jerome Powell and his team. Something Americans are paying attention to in today's CPI read is the cost of food. Now, last month, grocery prices were still up 0.3% from January and up 10.2% from the prior year. Yahoo Finance's Brooke De Palma is here with the details. Brooke, we're always keeping an eye on food inflation here.
Always keeping an eye on food inflation, especially as it continues to hit Americans. But some good news here for many inflation-weary consumers. This is actually the 6th consecutive month that the cost of groceries are rising at a slower rate. So not necessarily seeing a decrease, but rising at a slower rate. So some good news there. This follows the highest increase that we saw in August of 2022. Back then, there was a jump of 13.5%. That was the highest increase since March of 1970. 6.79 that is. And once again, this month we're seeing a jump year over year of 10.2%. Now, taking a closer look at the price of groceries in terms of categories, we're seeing numbers mostly up month over month. But as you can see right there, meats, poultry, fish, and eggs actually a decrease there. Now, that was brought down by the cost of eggs, which we'll get to in just a bit. But across the board, we're seeing decreases on breakfast cereal, frozen and refrigerated bakery goods, uncooked beef roast, bacon, and related products down 1.5%, and dried beans, peas, and lentils down 3.2%. Now, increases are flour and prepared flour mixes as the Ukraine-Russia invasion continues to take a toll on that supply chain. Also, in addition to that, pork up 0.7%. But the real good news here, eggs seeing a bit of relief. Prices there down 6.7% month over month, but still up 55.4% year over year as the avian flu outbreak continues to take a toll on the industry, and also something that agriculture economists are keeping a close eye on, especially as we approach the Easter holiday.
And we know that backlog from the avian flu, we know that that's going to persist for a while. So people should temper their expectations on that for sure. And Brooke, we know that this CPI read comes as Main Street is increasingly concerned over the economy based on the collapse of Signature Bank. And of course, last week's stronger than expected jobs results as well. What are some trends that you're noticing in this space?
Yeah, well, consumers certainly looking to value, to private labels for value, and also on top of that, perhaps switching up where they're going to the grocery store. And I spoke to a senior partner of McKinsey & Company, and she said specifically that consumers are saying here, I might be unhappy about the price of groceries, but I can still spend that money to buy groceries. So we saw in the latest earnings results that Walmart said that high income shoppers are going to their store amid stubborn inflation. We also heard a similar message from Costco in the latest earnings results, saying that consumers there are switching to their private label. They saw a growth there of 1.5% this past quarter compared to roughly 0.5% in terms of growth in its private label Kirkland brands. They said that people are looking to save money and they're turning to their brand, perhaps not a trade down, but a trade up, they jokingly said. But Target also investing in their private label brand. And also consumers here emphasized before switching baskets. Now that means good news for Dollar Tree, Dollar General, more consumers looking to seek value and perhaps switching where they're getting their full basket, going perhaps half their store shopping at a Kroger, at a Costco, at a Target, and then going to these dollar stores to get the rest of their needs. So certainly lots to watch in the coming months.
And a very discerning shopper here, taking their time and doing a bit of price comparison there as well. Brooke DePalma, thank you for that update. Great stuff. All right, well, inflation eased a peg in February, though it still remains high overall, putting the Fed in a tough spot with the recent bank failures complicating the central bank's objective of bringing us back down to that 2% inflation target. Well, for more on the outlook for the Fed's next rate hike, let's get to William Blair macro analyst Richard de Chazal. Thank you so much for joining me this morning. So, Richard, I want to ask you because obviously we saw CPI come in with expectations. Core CPI, though, still coming up a tick higher, especially what we saw with the jump in services as well. Can the Fed really breathe a sigh of relief at this point?
Yeah, I think this inflation report, which a lot of weight had been put on by the market, was encouraging in the sense that it was fairly boring. I think a difficult scenario would have been if the inflation report had come in much above the consensus expectations. And the fact that it generally met expectations was encouraging. But as Brooke just said earlier, I think what we're seeing is, disinflationary forces continuing to come through, but inflation as a whole is still too high for the Fed's liking. And I think as a result of that, what we'll probably see, and as we're seeing some of the market tensions ease around the Silicon Valley Bank, that I think paves the way to at least one more 25 basis point rate increase at next week's FOMC meeting. Powell earlier had sort of put on the table or paved the way in his recent testimony for perhaps doing a 50 basis point rate increase. But I think in light of the circumstances, that would seem to be off the table at the moment.
And do you think we'd be in this position if we took Silicon Valley Bank out of the equation and it just focused on the latest CPI data? Would 25 basis points still be the move, or do you think because it's been compounded that it now takes that 50 basis point hike off the table?
I think if you had taken Silicon Valley out of the equation, I think the odds would still be on 25, but wouldn't quite be as favorable in that direction.
And so one of the things that we heard Powell say is, they want to keep an eye on lag. We've heard that more and more in the conversation here. So then when you look at what was essentially a stress test for the banking system with SVB's collapse then, what does that, do you think, reveal about the pace and the speed and the size of the rate hike so far?
Yeah, I think it is absolutely symptomatic of monetary policy that is having its intended effect of tightening financial conditions in the economy. I think what we are seeing is that economic growth is slowly being suffocated. I think we're seeing that in many of the leading economic indicators, which we watch very closely, in particular the yield curve. We've seen a very sharp decline in building permits. We're seeing the money supply decline. And we're also seeing some of the more coincident economic indicators, things like industrial production. And as Brooke was even mentioning earlier, consumers starting to downtrade a little bit, maybe into private label. So we are starting to see economic growth slowing. And I think some of the tensions that we're seeing in the financial markets with Silicon Valley are a testament to that.
So then are there any opportunities to be found in this sort of environment where we still have this uncertainty about what the Fed is perhaps going to do after this current meeting?
I think, we are going to be in a tighter financial market environment for some time to come, with inflation still at 6%. I think even if the Fed, slows the pace of those rate increases, it's certainly telling us it wants to see policy remain tight for a while. We'll have to see what, if anything else appears on the horizon in the financial market environment in the banking system. It seems like that's off the table for the moment. But I think, we are looking at a more difficult economic environment over the coming several quarters.
And do you get a sense that the worst of the Silicon Valley Bank contagion and the fallout is behind us at this point?
It seems like it. I think the Fed has put forth a very powerful new BTTP facility, which is very significant. I think that should help to backstop a lot of the immediate pressure on the assets or forced sale of assets to meet depositors' demands. So I think, I never say never, and I think what we're seeing in the market today is indicative that we are working through this. The Fed has been pretty quick to address this situation. The banking system as a whole is still very sound. And I think that's quite positive from that perspective.
I do appreciate you joining me this morning for your insights. Richard Charles Albert, William Blair, macro analyst. Thank you for your time. All right, coming up, more on the collapse of Silicon Valley Bank after this. The sigh of relief for Silicon Valley Bank customers who now stand to recoup even uninsured deposits. And that's thanks to a narrow banking law exception tapped by the Biden administration. Yahoo Finance legal correspondent Alexis Keenan is here to explain. Hey, Alexis, I know a lot of people have questions here.
Yeah, Rochelle. So plenty, too, of really financially sophisticated folks who don't like the fact that the Biden administration has tapped this very narrow legal exception that allows the FDIC to reimburse both cash and cash equivalent deposits at failing banks in excess of $250,000. One of them being Citadel founder Ken Griffin, who said to the Financial Times reportedly that the government's reimbursement of these uninsured deposits amounted to evidence that there's a breakdown in American capitalism. So let's talk about the legal framework that actually makes all of this possible, makes the government able to give more than $250,000, so uninsured deposits at these failed banks. It comes from a 1991 law, and it's called the Federal Deposit Insurance Corporation Improvement Act. And it was adopted in response to failures at both commercial banks as well as in the savings and loan industry in the 1980s. And the law actually decreases the FDIC's power by directing the agency to resolve bank failures at what they say is, quote, the least cost to taxpayers. And even if that means that the losses to the depositors, losses to uninsured depositors, creditors, as well as shareholders, even if they lose money, they're supposed to, by law, go ahead and make those limitations. But this very narrow exception, it comes into play when the U.S. Treasury Secretary decides that this least cost method of limiting, let's say, $250,000 to reimbursements of these depositors at failed banks, when the Treasury Secretary says that it would cause systematic risk by adopting that method and that more reimbursement from the government would actually lessen, quote, serious adverse effects to economic conditions or to financial stability. So critics, though, of course, calling this move a bailout. Legal experts tell me that that's kind of a gray area. While bailout isn't a legal term, they say on one hand, the Biden administration is saying that taxpayers are not going to bear the cost of this move, that the assessments to the banks to refund the FDIC and its deposit fund, that's the money that will be used to pay out these losses. But on the other hand, they say that, look, the losses, the banks, you can better be sure that they're going to pass them eventually along to their customers who are these depositors at the bank. So kind of full circle there. Rochelle?
And we know, like, the word bailout can be quite triggering. People have compared it to, student loan debt and bailing out perhaps companies who didn't make it through the pandemic. Then what is the legal perspective on the critics who are actually calling this a bailout?
Yeah, so that's a little bit what I was just talking about there, is that they say, yes, the Biden administration has come out and said this is not a bailout because the funds will not be borne to recoup the federal insurance fund that pays out these losses, that the taxpayers won't have to do that. But the thinking is that at the end of the day, if the banks have to be assessed more money in their quarterly assessments that fund the FDIC's fund that actually pays these out, then that's just going to be a pass-along cost to customers. And at the end of the day, that customers will bear the cost here. So a lot of gray area, a lot of interpretation to be made. But this is what legal experts are at least telling me about this exception to the banking law.
I appreciate that breakdown. Alexis Keenan there for us. All right, well, with a large number of venture-backed startups using Silicon Valley Bank prior to its downfall, many investors are now wondering what's in store for VCs. Well, Passion Capital partner Eileen Burbridge joining us now. So, Eileen, first, I want to get to this idea of, obviously, when people think of tech companies, I think sometimes it gets lost just how many industries tech is interwoven in when we think of this, calling it a bailout. So what is your take on that? And it's really the narrative that's been surrounding this.
No, I really appreciate you, first of all, having me on, but also asking that question and letting me frame it, because I do think one early reaction to everything that happened on Friday was that tech was quite insulated as a sector, that it was probably just, affecting entrepreneurs or people who were tinkering in a garage or who were actually just working on really novel inventions or something that was really fanciful. And clearly what all of us knew or were concerned about was the knock-on effects and the fact that tech is now really not even its own sector. It permeates everything that happens in day-to-day life, in all of commerce, in all of business, across every industry sector, from payments to transport to notifications to healthcare, to literally everything that we rely on, all the way down to food supply, really. So this would have really had massive, massive knock-on effects.
So then in terms of how you're viewing risk management at some of these banks, especially the ones that do have a very high proportion of one particular sector, or especially when you have a very large chunk of these depositors who have 250,000 or more, what are some of the conversations that you're having in assessing risk right now?
Yeah, I mean, I think nobody knows, because if everyone knew, then everyone would be making deposits over there, or everyone would be doing exactly the same thing. I think the real lesson learned is the key is going to be diversification and making sure that there isn't too much concentration on one side or the other. On the one hand, for a company doing its treasury management, not to have too much concentration in all of its funds in one institution. For banks as well, for those institutions, not to have too much concentration or reliance on any particular sector.
And what do you think about some of the criticism about perhaps VCs that maybe got a little greedy, maybe didn't look at all the risks, and some of the pushback that people are saying, why should they be getting bailed out for this? But what would you say about that?
Yeah, I think it's an easy narrative, but actually, as you were just talking about with Alexis there, it's not a bailout, right? And I know President Biden's made a lot of effort to clarify that that's not the case. It's not the bank's shareholders that are being bought out, that it's not them that are going to be getting their equity value back. This is all about protecting depositors. So that's the first point. The second point is, this kind of goes back to what we were talking about earlier. Technology was not more inherently risky as depositors, or the types of clients and the companies that were holding their funds at these banks, they weren't riskier than any other kinds of depositors. And so really there wasn't anything inherently, I think, greedy or inappropriate on behalf of investors or anyone else who was actually banking with Silicon Valley Bank.
And I want to talk about some of the contagion that we saw, because we saw the reaction in US markets and for the US banks and the regional banks as well, even despite President Biden's assurances. But then when you look at the reaction that we saw in Asia and Europe as well, talk about that reaction and what you think that actually does for the VC landscape, the discussions being had.
Yeah, again, I think it's interesting because VCs and venture or investors, they're probably going to be the ones to move on most quickly. They're clearly worried about their assets. They're worried about their investments. They're wanting to make sure that their capital is not going to be at any kind of risk of contagion with respect to the banking sector. But once they have then access to the funds and they know that their assets or their portfolio companies are protected, they're still looking for value. They're still looking for innovation, and they're still looking to get a return on their investment. In terms of the global effect, or what you were alluding to, and the kind of aftershocks that are affecting Asia, that are affecting Europe, that's still very real. And I think we're going to see a little bit more jitteriness until the US situation is clear, and at least to stay what it feels like things are like now in the UK.
And are there certain sectors that look more attractive to you at the moment when we see US financials coming back slightly, still not where they were when you compare them to what we've seen over the last 2 days? Though, do you see any opportunities in this space right now?
I mean, there's always great opportunity, right? And you're seeing probably inflows at a number of institutions that are probably benefiting from what's happened in the last few days. Clearly, there's always opportunity in chaos. I think most, though, are probably just going to lay low, keep their heads down, make sure everything's back on track, make sure money's where it ought to be, all the accounts are accessible, and the funds are where they should be accounted for, and just wait it out for at least another week or two.
And we're still seeing discussions about what this means for oversight. What sort of oversight would help you sleep better at night as a VC investor?
Yeah, for the banking sector, I think that is a really, really important conversation. And I know far less about sort of banking regulations than I would do about sort of technology or what investors are thinking, or even startup and scale up founders might be thinking today. But oversight of the banking sector, I think it goes without saying, it's even more critical now than ever before. We've seen how the definition or, the case study or example of a bank run differs from what it did in 2008. And for all of history, everything's now online, everything's digital. You can see customers trying to withdraw 42 billion in 24 hours. We have to start adapting to what measures need to be in place, given how quickly things can spiral out of control.
And you raise an interesting point, because when people think of traditional bank runs, tellers could just shut the window. Now, just like that, with digital banking, it's really been a game changer. So what does this mean for startups then, and the sort of how they're approaching funding and their banking as well, do you think? What are some of the startups that you work with saying?
Yeah, I think all of them are breathing a huge sigh of relief, at least here in the UK. The ones that still have funds with Silicon Valley Bank in the US, they're probably waiting to see when they can get access to their funds. But then they're just all thinking about, again, diversifying across multiple accounts, whether that's leaving it now at HSBC, the new parent company for the SVB UK entity, or other banks. They're going to diversify. They're going to make sure not all of their capital is in one place. And then they're going to just breathe probably another sigh of relief and then carry on building and onwards and upwards.
Certainly lessons learned here indeed. People are going to be a lot more wary about where they're putting their money. A big thank you there to Passion Capital partner Eileen Burbidge. Thank you for your time this morning. All right, coming up, Moody's is out with a new outlook on the US banking system. Our Julie Hyman joins us to break down the latest next. Moody's Investors Service has downgraded the entire US banking system to a negative outlook from stable, citing a rapidly deteriorating operating environment. It added that banks with unrealized losses are under particular pressure. Well, joining us now with the latest is Yahoo Finance's Julie Hyman. Hey, Julie.
I mean, I guess on that last point, tell me something I don't know. We've all come to realize over the last few days, unrealized losses on certain bank balance sheets, once they are forced to realize those losses, become a problem. So just to talk about what exactly is happening here, Moody's coming out with this note late last night, but it was only just released publicly in the last hour or so. The headline on this note, outlook change to negative on rapidly deteriorating operating environment. And the Moody's analysts behind this saying that they made this call on the U.S. banking system, that there are concerns here, even despite the actions that the federal government took over the weekend to try to shore up the banking system. They write, while the Federal Reserve's new bank term funding program is constructive, we expect depositor and investor focus will turn to banks that may have a similar mismatch between deposits and asset duration, as well as weaker profitability and capital. We expect pressures to persist and be exacerbated by ongoing monetary policy tightening, with interest rates likely to remain higher for longer until inflation returns to within the Fed's target range. So this is not necessarily a problem that is now done. Bank stocks, by the way, have been rallying today. We learned late yesterday that Moody's was downgrading 6 individual regional banks. We didn't know yet about this bigger call on the banking system more holistically, if you will. We've got bank stocks that are actually rallying today, even in the face of us finding out about this call. That could be because many of them have fallen so much already, particularly if you look at the regional bank sector. Basically, what Moody's is saying is if you look at certain banks and the way that they have managed their assets, what they call asset liability management, at some banks they're faulty, and the interest rate increase cycle has made it more difficult, Rochelle, to manage through this particular time.
So, Julie, break down what a credit rating is and what happens when you do have one.
So you're looking here at not a specific credit rating. It's more of a sector outlook when we're looking at this particular case. So let's talk about credit ratings for individual companies and their debt first, because this is a call on the bonds or the credit of a company, their debt effectively. And basically what Moody's and S&P and Fitch try to do is measure the likelihood that they'll be able to repay those debts. So when you're talking about a company being downgraded, their credit being downgraded, it's just a little less likely that it will be able to repay those debts. Now, it's really on a spectrum of a system here. Why does it matter? Well, if you're a debt investor, it helps you game out what the risk profile is of a given company's debt. Again, this is not a credit rating downgrade per se because it's on a sector. It's more the outlook. So when they're talking about this banking system outlook, it reflects Moody's views of the credit fundamentals of the sector, the whole banking sector, over the next 12 to 18 months. So we're sort of talking about two separate but related things here, Rochelle. On the one hand, the credit rating for the individual banks, which Moody's made the call on yesterday, and now on the entire banking system.
It's certainly important to make that distinction. Our very own Julie Hyman, thank you so much. All right, let's give you a look ahead at what to expect. We're going to have the South by Southwest conference. It's in full swing in Austin, Texas. Yahoo Finance's crew is on the ground there, hearing firsthand from tech industry executives in the wake of the SVB collapse. We'll continue our coverage of South by Southwest this afternoon. All right, well, let's also do a final market check as we head into the noon hour. As we're seeing here, the Dow there still in positive territory, up there more than 400 points heading into the noon hour. The S&P there also there driven up almost 2% on the day. We're seeing financials gaining strongly compared to yesterday. So they're up almost 2% on the day for the S&P. Tech-heavy Nasdaq there also up more than 2.3% there, more than 260 points. We're seeing some strong gains from the FANG stocks in that performance as well. Well, that'll do it for me. I'm Rochelle Akufa, but I will be back at 11 a.m. Eastern tomorrow. I'll see you then.